back down to the lows of COVID. And so people are as negative towards oil today as they were when we were all locked in our homes and we were doing this virtually. So it's staggering to me that sentiment is as weak as it is. And I think the uncertainty is creating massive opportunities, many of which I'm sure on this show we'll talk to.
We will. I'm sure people will have a lot of calls about that. It's just getting people to sort of switch over to that, right, without panicking first about
Very
the
much
money
so.
loss.
And the panic is real.
Yeah,
we feel that.
Absolutely. Okay, we are going to be back with Eric Nuttall. He is partner and senior portfolio manager, 9 Point Partners, taking your questions today primarily on energy stocks. Here's how to reach us. We're back in a moment.
Gold standard, gold dust, pot of gold, solid gold. You're worth your weight in gold. Golden boy, golden girl, golden goose, golden egg, golden age, golden ticket, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
Double View Gold's Hat Project is potentially one of Canada's largest porphyry copper gold projects, with 477 million tons inferred and 150 million tons indicated copper gold resources, and a significant potential for scandium, an in-demand critical mineral.
When I acquired the project, the potential for copper was totally overlooked, but my belief was so strong that I actually mortgaged my home to drill it. We hit in the first year.
Double View Gold Corp, the one to watch.
This is severe weather. It's getting worse in Canada, and we are all paying the price. But this is what protecting Canadians from the impact of severe weather looks like. The 140,000 people in our home, auto, and business insurance industry working in your community, advocating for solutions that protect all Canadians. It's all part of our plan to protect the things we love.
Invest like a champion with Hamilton Champions ETF CMVP and SMVP. Exposure to Canadian and U.S. dividend all-stars. Hamilton Champions ETFs. Zero management fee until January 2026.
Welcome back to Market Call. Thanks for joining us today. We have Eric Nuttall in-house to take your questions. First, we'll go to an email from Sid in Vancouver. Sid writes this about Parex Resources. Can I get your guest thoughts on Parex Resources? Should I continue to hold or should I sell? We'll take a look at where Parex is today in just a moment as we pull out the line graph. There we go. So it has dropped 40% year over year, now hovering around 12.5, 12.6.
There's no reason to own Parex. You should sell it, especially if you can realize a tax loss and deploy the funds into a better name. They were a complete disaster last year. They incinerated hundreds of millions of dollars on a new area in Colombia that proved to be non-productive. They're now deeply in the penalty box. We are in a risk-off market where people are looking for reasons not to own a name. There's no money left to defend a name like this. And so, yes, it is inexpensive. My view is it's a value trap. We'll have 3 other names later on where we see meaningfully higher upside with meaningfully less downside.
Got it. Okay, get rid of Parex at this point. Let's move on to the phones. We have Wesley on the line at this hour. Wesley is calling today from Toronto. What's your question?
Hi. Thank you guys for taking my call. My question, in your professional opinion, what are your thoughts about Tamarack Energy, and more specifically, how does the net effects of FX change the company's WTI break-even per barrel on these type of companies versus Canadian dollar versus the U.S.? Sure. And if there is time, if you can briefly touch upon how this will also affect producers in light oil versus heavy oil?
Okay, so Tamarack, year over year up 15%, but has been taking a hit since the start of the year.
So true of the sector. So we've been adding to Tamarack very recently. We remain one of their top shareholders. It'd be about an 8.5% weight in my main fund. What we like about Tamarack is the majority of their production is now exposed to the Clearwater, which is one of the most economic oil plays in North America. Even at $70 oil, so kind of roughly where we trade today, the time with which they get their investment back on a well basis is measured in months. Like it'd be 10 to 11 months for payback period. So they're super economic. As Wesley pointed out, Tamarack, and in fact most companies, all companies, are benefiting from the weak loonie because they're selling in USD, repatriating that back, and yet their OPEX is in CAD. So that's a very significant tailwind. When we look at this name, we have it trading at 3.3 times cash flow this year, 2.8 next. More meaningfully to me is the free cash flow yield because they're using that to aggressively buy back their stock. And so we would have an 18% free cash flow yield right now. Very, very compelling, 20% forward, meaning you're getting a just under 4% dividend yield plus remaining buybacks. And they have well over 20 years of stay flat inventory. And at the same time, you're also getting a current valuation by our estimation, absolute free upside to their water flooding. So that's using water flooding to increase pressure, recover barrels. It's costing them roughly $6 to find and develop a water flooded barrel. So the economics are they're mind blowing. So we think it's materially mispriced, as is the sector. We would put a 5 target multiple that would suggest about a $7 target price 1 year out at $70 oil.
Got it. Okay, a lot of information to digest there. Let's move on to John, who's calling today from London, Ontario. Hi, John.
Thank you, Marilla, for timely and tariff-free business television. Eric, CES Energy Resources, you put me onto it. I think it was about $2. It's had a great ride. It does a lot of work in the U.S. And the question I have to ask on top of that is, what about tariffs and CES Energy Resources? Thanks very much, Eric. Have a great day.
Yeah, let me interrupt you just for a moment, because I think there's a lot of, not a lot of clarity, we'll say, around what products are going to be tariffed. And I know some of that changes routinely out of Washington. But we know that there is an energy tariff of 10% from the U.S. And if things are covered under the trade deal, they're not tariffed. But is it clear from that direction what products are going to be marked up 10%?
At this point, no. And honestly, I think tariffs is a massive distraction. So even if you assume 10% tariffs on Canadian oil, we did the analysis, it's about a 7% hit to cash flow maximum. And that was assuming that the loonie doesn't fall further, which we think is reasonable, right? Like if a 10% on energy means a 25% on everything else, the loonie is going materially lower. There is actually a scenario that I can paint where cash flow is actually higher under tariffs, given the magnitude of the likely magnitude sell-off in the loonie. So tariffs are actually potentially positive for Canadian oil and gas companies. That's very non-consensus. So honestly, it's complete noise and it's a distraction. Our base case remains that tariffs will not be in place for long, even if they are, because essentially it's a direct tax on the U.S. consumer. PADD 2 refineries in the Chicago area import in 3 million barrels per day of Canadian heavy via pipeline. You can't barge, you can't truck other sources of 3 million barrels per day. And in fact, globally, they don't exist. So that's about a 17 cents per gallon tax on the U.S. consumer, which equates to $22 billion of less consumer discretionary spending. So it's complete idiocy. It achieves nothing. We don't think it will be in place because it's massively inflationary. On CES, so I'm glad you did well. We did very well on the stock too. We have sold it because our interest in holding service stocks right now is low. We do not see the U.S. rig count and by extension activity increasing in oil going forward. We think gas, ultimately the call on gas production growth is there for the second half of this year and into 2026. But we just think pure play natural gas and or oil names will do better. They're benefiting from the Schlumberger acquisition of ChampionX. They're gaining market share. You've seen their margin expand to roughly 17%. They're now talking about the billion-dollar market potential of offshore, which they've never had progress with before, so that's a new market for them. The stock remains inexpensive, as is the entire sector, so we have it at a free cash flow of roughly 19%. 4.4 times, where Champion X, I think, got taken out at 8 or 9 times. So we see meaningful upside. We just, thematically, we want to be more in pure natural gas names or oil names right now.
Got it. Okay, we do have to take a quick break here on Market Call. Eric Nuttall's in-house today with your questions on energy stocks. Back in a moment.
In today's turbulent markets, Starcore works to minimize risk and maximize shareholder value. Our established management team is unlocking the mystery of the source of mineralization at our producing San Martin gold mine, while using free cash flow to explore our portfolio of advanced assets in Mexico, Canada, and Côte d'Ivoire, Africa. With no debt, Starcore offers investors leverage at every stage of the mining life cycle, from exploration to production. Learn more at starcore.com.
Harvest Healthcare Leaders Enhanced Income ETF. Maximize your monthly cash flow from Canada's leading healthcare ETF. More income from healthcare leaders. Harvest ETFs. Income happens here.
No matter what kind of teeth you gotta brush, Oral-B Electric cleans better with one simple touch. Oral-B's dentist-inspired round brush head hugs them, cleans them, and gets in between them for 100% cleaner teeth. Your perfect clean routine starts with Oral-B.
On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
Welcome back to Market Call. Thanks very much for joining us. We're going right to the phone lines. David has been holding on the line from Ottawa. Hi, David. What's your question today for Eric?
Yes, good afternoon. Thank you for taking my call. My question is on CNQ. And although it's one of the best energy companies in Canada, if not the largest, I don't understand why the stock price is at a 52-week low. It's been declining most of 2024, and it's still going down. Do you own CNQ, and are you a fan of this company? Thank you very much. Have a great day.
Yeah, so CNQ is about a 10% weight in my fund. There's a few reasons why it's being sold off. So you have to appreciate it's non-fundamentally based. First off is Canada is for sale. The Canadian market at large has been for sale since January due to Trump tariffs. Secondly, energy is for sale, again, owing to oil tariffs. And CNQ would be one of the more exposed companies. I think there's been a pair trade where investors have been going long Suncor and short CNQ, as they don't have the benefit of refinery exposure, not nearly as much as a Suncor. And so we actually own Suncor. We sold it and bought more CNQ with it. As you correctly point out, CNQ is one of the deepest reserve bases of any company on the planet. If we're directionally accurate that U.S. shale is peaking in the next couple of years and non-OPEC supply growth is peaking in the next 2 years as well, there's going to be a massive seek for companies that have deep, deep reserves, as the demand for oil is going to grow much longer and stronger than consensus believes. CNQ will be a prime beneficiary of that because it's large enough for any institution on the planet to be able to take a sizable stake. We look at it trading at 6.4 times cash flow at $70 oil, an 11% free cash flow yield. We're getting about a 9% cash return. That's between the dividend and the share buyback for a company with well over 50 years of stay-flat inventory. So we think it's been massively oversold because of the sell energy, sell Canada themes, and we're taking advantage of that. We can't buy any more because it's at our fund max weight.
Got it. Okay. So hold on to that. We'll move back to the phone line. Silka is on the line from Toronto. Hi, Silka.
Hello?
Hi, Silka. What's your question today?
Yes. Oh, I have a question regarding Freehold.
Go ahead. Okay, I'm not sure.
Probably should she own it or
If she
not,
can
would
hear
be
us,
my
yes.
guess. So Freehold continues to be a large weight in the energy income fund that we manage. It's now yielding 9%, which is astounding to me. Some of the dividend yields are phenomenal. This company, like, that would be defendable well below current oil price. I'm cuffing this, but roughly $5 and probably $2 gas. So it's a royalty co. You're not taking exploration risk, capex risk, etc. They just receive checks in the mail on a monthly basis. They've shown the ability to expand into the United States. I think critical in their next quarter will be hopefully showing a stabilization of U.S. Volumes. They've continued to do accretive deals in the United States because running room in Canada is not as deep. So I look at it a name where, you know, capital appreciation, I've recommended this in the past, and we've always framed it the same way. You should be looking for modest capital appreciation. It will always lag a pure play E&P, but at the same time, you're getting a 9% dividend yield, which we believe to be phenomenally stable, and you're getting the ongoing, hopefully, accretion of M&A in the United States. So again, if you're an income investor, you're looking for a pretty juicy yield that's fairly defendable, with modest upside appreciation, we think it's a great name to own.
And where are they expanding in the U.S., or where are they looking to expand? Largely
the Permian. That's really the only basin of size and scale with growth prospects is the Eagle Ford and the Bakken are either flat or in decline.
Got it. Okay, we'll go back to the phones. Tom's on the line from Kingston today. Hi, Tom.
Thank you, Morella. I bought New Vista because I believe it has a good chance of growing with this new pipeline that's going to Kitimat. I believe it's well positioned to profit from this. Is ARC a better choice?
Right.
And my second question, I give you a bonus question. Why isn't there why is no one talking about a pipeline to the Hudson Bay coast?
Okay.
We could have done a lot of things with that.
Tom,
anyway,
okay, thank you. All right, we'll wrap it up. So, Tom, Hudson Bay doesn't work. It's only 3 months a year where you've got free seas, so the economics of a pipeline don't work because the amount of icebreakers and such. New Vista, we remain one of their largest shareholders. I think we're second after Paramount. We think there's a deep value in this name. We continue, I think it's be roughly a 10% weight in our fund. What we see is a company that is going to be growing their production by about 50% over the next 5 years, while free cash flowing roughly 70% to 80% of their current market cap over that time frame. And when they get to a peak plateau production of about 120,000 BOEs per day, they then have the inventory to keep that level flat for almost 30 years. So as they're growing, we're getting free cash flow back to the shareholders. But at the same time, once they reach that peak in a several years' time, the amount of free cash flow is going to be mind-blowing to us. And so we continue to add on every opportunity whenever it dips below a 10%. We see roughly 50% upside on a one-year basis. But looking 1 year out on companies with decades worth of inventory, I don't think does it justice. And so we're going to be patient to allow Mike and his team to realize the value, and we're going to be sticking with this one.
All right, let's go back to the phone lines. We have a Florida caller today. Jack's on the line. Hi, Jack.
Thank you for taking my call. My question is on Chord Energy. I held Enerplus, and when Chord bought Enerplus, I bought Chord.
Yeah.
And I've been underwater ever since, so I'm wondering if I should hang on or take my loss and move on. So,
yeah, so if you think Canadian mid-caps are out of favor, welcome to the United States. Like, there's just been, when you're only 5% of the market, not 18%, there's just no buyers because the energy names to most generalist investors in the U.S. are completely irrelevant. And so not only that impact on Chord, but also this effect of Enerplus shareholders getting Chord stock, not knowing what to do with it, so they've been selling that as well. So what you're getting with Chord is a company with at least 10 years of stay-flat inventory. So not decades and decades, what you get in the oil sands, but for a U.S., well, I'm going to call them a shale company, that's pretty good. The name's trading at a 14% free cash flow yield. They're returning at least 3/4 of that back to shareholders, predominantly in the form of buybacks. Is trading sub 3 times. So it's deep value. My challenge, though, is you need a U.S. investor to care, because Canadian investors likely are not, because we have adequate opportunities north of the border. And so it's kind of stuck. I can't quite see the catalyst to drive a meaningful re-rating other than a meaningful increase in the oil price, which honestly we don't see happening for the next year or so.
Got it. Okay, Eric is sticking around to take your questions on energy stocks, but we're taking a quick break. We're back in a moment.
I want to make consistent double-digit returns.
VectorVest.
I want to buy and keep more stocks that keep going up.
VectorVest.
I want a simpler way to manage my portfolio.
It's all here for you to see and try at vectorvest.ca. Market timing indicators that work, simpler, clearer advice, strategies that pay off, and analysis tools second to none. Try it risk-free 30 days under $10 at vectorvest.ca. VectorVest, everything you need for everything you want.
Oh, it's mesmerizing.
I can't look away.
Cleaning that greasy mess?
And not even scrubbing.
Well, fluff my feathers.
Dawn Platinum is bringing it.
You know it. It cuts through the grease better than their old dish soap.
Keep quacking.
Platinum breaks down the slimy stuff it would leave behind, removing 99% of grease and food residue. That's why only Dawn is trusted to save wildlife.
Yeah.
I'd fly south for a clean like that.
Dawn Platinum, the better grease getter.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Canada's housing challenge demands bold solutions. At Clifton Blake, we're transforming neighborhoods with smart, mixed-use, purpose-built developments. With decades of expertise and a reputation for trust, Clifton Blake offers accredited investors an opportunity to make an impact while achieving financial growth. Invest with us in our communities. Be our partner. Join us in building the future.
My squad nice, my squad good, my squad rep, my city, my hood. Cobra Flash! Squad ready, yeah, we coming for them shots. Got 10 plays, yeah, we coming for them spots. Got 10 ways, I can put you on lock. Put you on blocks, K.I. with the rock. My squad nice, my squad good, my squad rep, my city, my hood. Yo, I'm the main event dog, I'm the last fight. I hit you with the right, and the left flurry. Just like Chef Curry, gold medal, no mercy.
See the man on stage, feel you, getting all the piece of pie for your wife. Everybody wanna know how it feels. Alright,
I respect her.
Welcome back to Market Call. Thanks for joining us. Time for our guest past picks. Eric Nettles' past picks are from April of last year, so April 2nd of 2024. And right off the top, a winner, Varen, of course, which announced the merger this week, and so was up by quite a bit, although Whitecap went down. So let's take a look. At the time, you recommended it. It was 11.52. It's now 8.49, and return of -26 and -23. So obviously some fluctuation there. Tell me why you picked Varen at the time last year.
Yeah, so Varen was in the pole position to gain kind of that mid-cap status of investable. They had finished several years of acquisitions. They'd built meaningful inventory. They were drilling some of the most economic wells ever drilled in the Montney. Later last year, they went on to try a different frac technique using a different tool that failed to work. And so they overcapitalized one area. It was a risk-off market. People condemned the value of all of their acreage on that. And so we meaningfully added to our exposure. We owned 20 million shares heading into the news on Monday. So I think we're their largest shareholder, their largest active shareholder. More importantly, though, is, okay, we've got the deal. Whitecap, my view is Whitecap, I know the headline premium was high of 39%. My view is Whitecap was almost stealing the asset. And I think they're being very opportunistic in their timing, as they should, because I think they saw what we saw, and that was the technical merits of the team at Veren identified very high quality rock. Undoubtedly, they screwed up, they owned it, and they've been digging themselves out from that. Subsequent to year end, we've had a reserve report with no technical revisions. So the reserve engineers validated our view, and my partners, via Keegan, who spent a lot of time with our technical team. After that, they've drilled a very boomer pad, and we thought they were a month away from releasing well results that was going to completely validate our view. And so my guess is Whitecap drove the bus in terms of timing. This merger between the two is very complementary. There's very strong asset overlap. And it could have been either management team leading the pro forma entity. I just think given that Veren was still in a period of, or situation of somewhat weakness because the market hadn't fully seen what we saw, it ended up being the Whitecap team. And so we think they're getting a very high quality asset at a reduced price owing to market volatility. We think that size and scale matters. Mid-caps have been left for dead by large institutional investors. And so becoming the 6th to 7th largest producer in Canada with a 9% dividend yield that's sustainable down to $51, we think will force large institutions to look, because at $70 oil, pro forma, they're trading at about 3.1 times cash flow, a 17% free cash flow yield, a 9% dividend yield, and they have well over 20 years of stay flat inventory, and that's very high quality inventory. And so we see the strategic benefit over time. I cannot intelligently explain why Whitecap fell by 15% yesterday. I think there were other factors to that. And we think given they're going to be on the road for the next 3 weeks, selling the sizzle, explaining the strategic rationale, talking about the synergies, et cetera, we see Whitecap recouping a lot of yesterday's losses, and by extension then Veren more closely reflecting a 39% premium.
Yeah, it was interesting to see Veren get a bump and then Whitecap go down in the opposite column, but we'll see what happens in the next days and weeks ahead. Let's go to your next top pick from last April, which was Baytech. It was recommended at $5.30. It's now down to $2.89, so a dropped return of 46%, 45% for the total return. What happened with Baytech?
So drill bit-wise, execution-wise, they did exactly what they told us that they would do. You've seen massive multiple contraction in the small and mid-cap space. We exited at about 385 to 390. We had a distribution that we generated over 100 million of gains last year, so we had to distribute that to our clients. We had to minimize that. This was one of the names that we had losses on. It's effectively in an air pocket now, where it's just been falling on no natural buyers as energy is out of favor. It's deeply contrarian. The stock is undoubtedly inexpensive, 2.6 times cash flow, a 24% free cash flow yield. They're using half of that free cash flow to buy back their shares. They pay a modest dividend. They're just, for a fresh dollar today, I think there are other names that will probably lead first. But I think Eric Grieger and his team have been executing on exactly what they told us that they would do. The quality of the acquisition that they made, God, is it 2 years ago now? I think they've validated that, but it's in a sector of the market that is totally out of favor.
Would you dip back in at all? At this?
Every day is a new day.
Okay.
So they do have a large shareholder. I would say in a slightly higher oil price environment, this name really hums at 75. So if I thought we were going to be at 75 and sustainable, so let's say a year from now, there is an overhang. There's a large shareholder with 11 to 12% of the stock. That's an overhang. I like opportunities where we can make a call, we can take care of an overhang and lead to a multiple expansion. Every day is a new day.
Got it. Okay, let's go to your last pick from April of last year. Precision Drilling, recommended at 96.01 and now down 63.43, 32% drop for both return and total return. Where did Precision Drilling go wrong? What happened there?
Yeah, so you see a theme here. And I will say, I've been doing the show for, I think, 14 years. You want to buy a sector when the guest looks like a complete moron. And so that's me right now. What happened to Precision? We bought 9.9% of the company at roughly 75. It rallied into 110. We exited it at $88. Services have been selling off meaningfully as gas was weak, not that long ago. Oil was weak. Discipline remains. And the challenge with drillers is they've gotten too good. They've become too efficient. So E&Ps are drilling wells with less time, i.e. less demand for the rigs, but they don't increase the number of wells because investors want capital discipline. And so they've kind of shot themselves in the foot by becoming too good, and they are not getting the economic rent of that. The producers are, hence why I don't own any service companies right now. I will say it is getting tempting. I asked my partner Keegan this morning, like, how do we feel about the numbers? We feel pretty good. It's trading at 3 times EBITDA and a 32% free cash flow yield. Like, that's pretty damn compelling. That's, in fact, the same metrics as when we initially bought the stock. So my challenge as a fund manager is there are so many opportunities that look extremely compelling. We'll outline some later. Where do you want to go? What do I want to own now is I want to own natural gas, predominantly in the U.S., and I want to own oil companies in Canada with decades worth of inventory at a time where we're nearing peak shale, where we're getting all of the free cash flow back in the form of buybacks. Those are my 2 main focuses right now.
Okay, and we'll take a look at your forward picks a little bit later. Right now, a quick break. When we come back, Eric Nuttall will take your phone calls again on energy stocks. We're back in a moment.
Interactive Brokers pays up to 3.83% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
What's up? You seem kind of sluggish today.
Things aren't really moving.
You could use some Metamucil.
Metamucil's plant-based psyllium fiber helps keep your digestive system moving so you can feel lighter. Metamucil keeps you moving. And try the 2-week challenge at metamucil.ca.
Want to get the most out of one sheet? Grab Bounty. It's inspired by a dishcloth, and you can ditch the mess when you're done. Bounty, the quicker picker-upper.
Stability is one of the things that makes Capital Direct One Income Trust unique and reliable.
If you're looking to invest, then Capital Direct could be right for you.
Our proven track record boasts stable income, portfolio diversification, and compound growth.
Throughout 2024, Capital Direct's return trended upwards, with Class F hitting 10% annualized return and Class A and C kicking out over 9%.
For consistent returns on your assets, find us online.
Or give us a call.
CapitalDirect.ca.
Just close the doors, and you're in a world of your own. Travel is not just about the destination, it's also about how you get there. Fly Emirates, fly better.
A lot of hot women away from home, acting all anonymous. I just don't understand why you wouldn't hook up with me.
Because you're soulless.
It's the perfect week for a fling.
She's an aging actress. It's pathetic.
Actresses are all basically prostitutes. Am I right?
Welcome back. Let's get right to your phone calls. Daniel is on the line today from Markham, Ontario, with a question for Eric Nuttall. Daniel, what is your question today?
Hi, Marilla. Hi, Eric.
Hi, Daniel.
May I have your thoughts on Headwater exploration? Does it match your investment thesis of great management team, quality assets, free cash flow yield, and buying back stock? And do you personally own it?
Yeah.
And as usual, one of the best and favorite guests on Market Call, and
thank you.
Marilla, great host. Thank you.
Thank you.
No, I've been warned we have more callers than we have time, so I'm going to try to be pretty punchy. So when I have questions, let's do the same. Headwater is an exceptionally well-run mid-cap, small-cap oil company that's yielding 7.5%. Jason and his team have done a phenomenal job of aggregating assets. I don't own it in the fund or personally. It's just I can only own 70 mid caps. And so there's other names where perhaps from a valuation perspective, it's a little more intriguing to me. Headwater, they've done a great job in the Clearwater, super economic, similar to Tamarack. I would favor Tamarack over Headwater for Clearwater exposure. They also have several exploration plays with which they've had success on so far to expand their asset base. And so if you're looking for modest production growth combined with a very juicy yield, we see meaningful upside, roughly $9 target, 57% upside from here. There's just so many mid-caps that I can own in the fund. So we're really calling non-core names, and we've really tightened. Like my top 10 would be 89% of the fund right now.
Got it. Okay, let's go back to the phone. Bill is on the line from Toronto. Hi, Bill.
Hi there. Thanks for taking my call. Eric, I believe the last time you were on the show, you mentioned Lycos Energy as being one of those stocks where the street just doesn't understand its true value.
Yep.
Do you still own it, or did you own it? And would you be a buyer at these prices?
I would,
below $2. Thank you.
I wouldn't buy it. It's a small cap company for which there are no buyers. I think we own 10% of the company. That's a whopping $10 million position. It's 1.7 times. They're growing. It's amazing. If you pull up the stock chart, it's just been creamed. And yet they've done everything. They've done everything that they've told us. So it's probably down 40%, give or take. We're down 35%. They've executed phenomenally well. They continue to delineate, expand, et cetera. So they're pursuing strategic alternatives, i.e. they're going to sell the company. We are strongly in favor of that. We're hoping to get paper in a larger entity that could reclaim some of the lost value. So the team's done nothing wrong. It's just this is a small cap that remains out of favor. The small cap model in Canada is dead. And so I think we all just have to recognize that and move on. So the team's done nothing wrong. It's just they're a victim of profound apathy towards small cap energy stocks in Canada for 2 years now.
Lycos is LCX, so they're down to $2.03. Does that sound right?
Yep.
Okay, got it. All right, let's move on to Mike. Mike is calling from Montreal. Hi, Mike.
Hi, how are you? Is it possible to have Eric's opinion on Cenovus Energy? With being like one of the top 4 largest oil companies in Canada, do you still view it as you plan on going back to it? Because I know you held it in the past.
Got it. Okay.
And would you be able to comment on the downstream impact from Q4? And we remain bullish. Have a good day.
Thank you.
Cenovus, we think, is a bit of a value trap. I never thought I wouldn't find it overly compelling, below $20. In January, they gave an investor update and said they needed another 2 years to fix their downstream to be competitive with pure play refiners. And so that the ultimate catalyst that we've all been praying for and waiting for to get them to, reclaim their lost multiple is just being deferred and deferred and deferred. They've been incredibly timid in terms of their pace of share buybacks over the last couple of months. And so we see better upside in C&Q today. Is the stock cheap? Absolutely. It's 4 times cash flow, 11% free cash flow yield. They're buying back, or theoretically, they're supposed to be buying back stock with all that free cash flow. It's just the downstream continues to bite them in the behind, where it was negative EBITDA. So yes, while it's only 15% of their total corporate EBITDA, when it's negative, that's a bit of a problem. And so we're really hopeful. We're rooting for them. We see nothing wrong with the management team, et cetera. It's just it's delayed gratification and a challenge tape where people need certainty in terms of when that catalyst is going to be. And with turnarounds now, we're going to be waiting till Q3 at the absolute earliest.
Got it. Okay, we have to take a quick break. We're back with Eric Nuttall in a moment, taking your questions today on energy stocks. Back in a moment.
Four legends competing to create the next superstar.
Bitcoin is surging as major financial institutions rapidly integrate it into their portfolios.
Bitcoin since the election has gone from $60,000 to $100,000.
Deregulation across the nation means strong support for Bitcoin, and Hive is thriving. Hive is positioned to quadruple their global footprint in 2025, aiming to capture 3% of the world's Bitcoin supply. Hive Digital Technologies.
Ever notice some odors don't come out in the wash? Odors like those from sweat, urine, and other musty odors can get trapped in fabrics. Try Downy Purifying Rinse. Just add to the fabric softener drawer. It's formulated with odor-releasing technology to help remove odors 3 times better than detergent alone. Plus, it's gentle on sensitive skin and on all fabrics. Release trapped odors the first time with Downy Purifying Rinse. Also available and fragrance-free. Brand power, helping you buy better.
Bell 5G Plus? What does the plus mean?
Have you heard about a weekly? It's the first long-acting insulin with once-a-week dosing. Get the ball rolling. Ask your doctor if a weekly is the right long-acting insulin for you, and visit aweekly.ca.
Invest in high-quality dividend growth stocks. Get high monthly income and enhanced returns. Add these top-performing dividend funds to your portfolio. DGS and GDV on the TSX.
Closed captioning of this BNN Bloomberg program is brought to you in part by Scotia iTrade. You have what it takes to start direct investing. We have the rest. Scotia iTrade.
Welcome back. Eric Nuttall is our guest today. He's taking your questions and your phone calls. Greg is on the line from Amherstburg, Ontario. Hi, Greg.
Hi, how are you doing?
Okay.
I wanted to ask Eric about Advantage Energy. I've held it since before COVID, and it's run up quite a bit, but I think it's at a plateau, and I wonder if you think hang on to it.
I would sell it. I think there are far better names. The CEO and the board did one of the worst acquisitions in Canadian modern history at a time when people were warming up to natural gas. They went and added liquids exposure. Since the time, last time we'd ran the analysis, from the time of that acquisition, they are the worst performing natural gas stock in North America. And so we just don't see the upside. They have an activist that has just entered the name of, I believe it's Kimmeridge, owns 6% of the stock. They've put some members on the board seeking strategic alternatives. In a post-ESG world, we don't see the value for Entropy, which was once heralded as going to be this massive catalyst. We believed at one point, when we actually did own the stock, that they had good natural gas reserves and inventory, but their acquisition shaked our confidence in that. And so as investors are increasingly warming up to natural gas, as they realize that natural gas is not a bridge fuel, it is the fuel of choice going forward, our strong inclination is to get more exposure either in the United States. We're very large shareholders in EQT and Expandus too. And in Canada, we prefer natural gas with some condensate kicker, such as ARC and Nuvista. We do not see the investment thesis in Advantage.
Got it. Okay, let's go back to the phone lines. Peter on the line from Toronto. Hi, Peter.
Hi, good afternoon, all. My question, Eric, is on Devon Energy. The next quarter or two, in terms of a trading stock, what do you foresee for that company? I'll hang up and listen.
We don't buy companies for quarters. Devon underperformed meaningfully last year. From an execution perspective, they've been righting the ship after many quarters of disappointments. We see the stock as offering deep value, trading at 4 times, roughly a 15% free cash flow yield. We're still a little worried about inventory depth, specifically in the Permian. So if I contrast a Devon with a company like a CNQ, where I'm getting way better inventory depth, way better execution, more higher dividend, triple the dividend, more share buybacks, I would strongly favor Canadian oil companies. I cannot find more attractive opportunities than Canadian oil sands companies today. You get the benefit of decades worth of inventory, rock solid balance sheets, strong execution, excluding Cenovus in that conversation, of course, and meaningful share buybacks compounding over time.
Let's go back to the line. Liam on the line today, calling from Calgary with his question. Hi, Liam.
Hi, how you doing today, people?
Well, thanks.
Great to hear you on the show today, Eric.
Thank you.
My question follows up on the last two comments you've made regarding oil sands majors. In light of the recent Whitecap Varen consolidation in this downgraded environment, which again is paper versus real barrels, my question is, some of these oil sands are strong and some of them are very weak. And I'm not going to mention names. And I know you don't like to comment on consolidation, but could that potentially happen in the oil sands?
You could see it. When you look at names that have stumbled, like a Cenovus, names that have executed well, like a Suncor, where Rich Kruger, I think he was just nominated CEO of the year, and he sure as hell deserves that. He's done an unbelievable job. Any of the doubters, he's silenced them with very, very strong execution. So Suncor could be an acquirer. When we look at values, opportunities, you've got Cenovus. Would make a lot of sense. Suncor's done a terrific job of taking the market's focus off of base mine depletion, which is an issue down the road, 8 to 10 years from now. We have two other oil sand names, which we'll talk about in 5 or 6 minutes' time, where we also think they could be feedstock. So Suncor has regained its lost multiple. It now trades at a slight premium, certainly to a Cenovus. We could see them being an acquirer. We hope they won't, because we don't own Cenovus, but we own two other names that would be natural fodder for them, and we would prefer to benefit from meaningful share buybacks over time, where we see more than 100% upside in each of them over a couple of years' time. We'd rather not see like a Varen, suppose you make 39% overnight when you see more than 100% upside over time. But we think the strategic value of oil sands is only going to be going up in a world where we have lost short cycle production from U.S. shale, where companies are not sufficiently investing, where demand's going to grow, we think, for at least another 15 plus years, and where even OPEC itself, due to challenges with OPEC spare capacity, I don't think they are able to answer the call on OPEC beyond the next couple of years. So we've got, I think, a really, really exciting opportunity. We just have to get through the next 9 months to a year. And so the value of Canadian oil sands at large, I think, is only going up.
Okay, let's see if we have time for one more phone call. Myron's on the line from Scarborough, Ontario. Hi, Myron.
Hi, Eric. Thanks for taking my call.
You bet.
And I was calling on the kelp.
Yeah.
It's well, I guess a small mid cap. I don't know how you're going to term it now, but seeing that we just had this merger again with Whitecap, which I'm a large shareholder. And also Varen, in light of what you said earlier, that
I understand.
The small caps and mid caps are left for dead.
Yeah.
What do you think? What do you think of kelp?
Yeah, so
and do you own it, or would you buy it at this price?
Yeah, we don't own kelp right now. Again, there's only so many mid caps that we can own. We see the deep value inherent in the asset that kelp has put together. Like Dave, Sadiq, and their team, they've always built this company to sell either part or all of, and they've done a phenomenal job in their last iteration selling to Exxon. We think that's down the road, whether it's the next 9 months, whether it's the next year. Well results have been improving, validating the value of the assets that they've acquired. It's just timing is a bit uncertain. So we can only own so many mid-caps. We've picked our horses. It's not one of them for now. Every day is a new day. We see the value inherent in the assets, and we wouldn't be surprised if a year from now they're very different, looking similar to what Paramount did. They sold off most of their production, took cash to reinvest, and basically replace what they had. So we see the value. We're just not there today.
We will leave it there with Myron as the last phone call today, but don't go away. Our guest top picks, that's coming up next. Stay tuned.
Recently inherited $10 million or more? A significant inheritance can be complex. At Stinnerworld Partners, we can provide specialized guidance to inheritors. Contact us today in complete confidence. We'll be here when you are ready.
Bell 5G Plus? What does the plus mean?
We all need fiber for our digestive health, but most Canadians only get about 50% of the fiber they need. Good thing Metamucil gummies are an easy way to get plant-based fiber. 3 gummies have the same amount of fiber as 2 cups of broccoli. Metamucil gummies, the easy way to get your daily fiber.
Quotes about money. Every advisor in every old financial institution has one. Like this gem. A wise person should have money in their head, but not in their heart. What difference does it make if it doesn't end up in your pocket? So, how do you get yours? The answer is 0. Questrade thinks you deserve more zeros. So they changed the game again with 0 commission trades. Now go get yours.
At Genesis, centered around you means reflecting your every need. Like respecting your time with 5 years of vehicle care and providing you with all-inclusive seasonal care, including winter tires, installation, storage, and valet service. This is effortless ownership. This is what sets Genesis apart.
I just took a shower above the clouds. You know why? Because this is the Emirates A380.
Today's best variety, Move Radio. Find out all the ways to listen at moveradio.ca.
Welcome back. Time now for our guest top picks. Eric Nuttall's first pick on the list is MEG Energy on the TSX. Why do you like MEG Energy?
So MEG remains one of our largest holdings. It's roughly an 11% weight in our fund. It's sold off year to date, I think, primarily due to tariff worries. The concern that, differentials for WCS, Canadian heavy oil, are going to blow out. Funny enough, they actually just hit, I think, a 1-year low right now. So phenomenally profitable. The market is discounting the likelihood of tariffs reasons, which we've covered earlier on in the show. MEG over the next 5 years, owing to the depth of their inventory, we think they have well over 35 years of stay-flat inventory. So over the next 5 years, they will grow production by 25%, while also buying back half of their shares outstanding, funded out of remaining free cash flow, while also paying a dividend. We see the stock at $70 oil trading at 4 times forward cash flow, a 13% free cash flow yield. We are bullish on oil for 2026 and beyond, and so they have very significant leverage to a rising oil price. If we just add on another $10, so we go from $70 to $80, they could not buy back half of their stock. They could buy back 80% of their shares outstanding over the 5 years, while also growing production. And so we think it's been heavily sold off. We are aware of active shorting from hedge funds around tariff noise. We think this is at least a $30 stock 1 year out if the stars align, but we see significantly higher value over time, because the biggest opportunity the market is overlooking now is the benefit of significant share buybacks compounding over time, because the remaining shares become more and more and more valuable, especially companies with decades and decades worth of inventory.
Got it. Okay, let's get to your next topic, which is Athabasca Oil. Why do you like Athabasca?
So this too is sold off. We've been adding on every opportunity. We would be one of their top shareholders. Again, similar to MEG, this company is going to modestly grow production over the next 5 years, while at the current share price, able to buy 68% of their shares outstanding at the current oil price. Massive leverage to a rising oil price. If we go from 70 to 80, they could almost privatize out of free cash flow. In fact, in 5 years from now, at $70 oil, because of the both growing their production and buying back their shares, they will free cash flow their current share price in 5 years' time. And yet this is a company with at least 50 years of stay-flat inventory. And so we see profound upside, again, over time. I can give a 1-year target, but that doesn't really do the story justice. It's the compounding impact of retiring shares month after month, quarter after quarter, year after year, and that is exactly what they are doing. Shareholders are getting 100% of that free cash flow back. And so even just at a flat oil price, They'll go from a 3.9 times multiple this year to 3.2 next year to 2.2 in 27, 1.4 in 2028, and 0.3 times cash flow in 2029. That's at a flat oil price at $70 oil.
Okay, we're at 66.50 today as we check and move on. Let's go to your last pick of the day, which is ARC Resources. Tell me about ARC.
ARC is our favorite way to get Canadian natural gas exposure. They just signed a great deal with Exxon where they'll now be selling 25% of their natural gas at international pricing. What you get with ARC is deep, deep inventory, decades worth of stay flat. You get a board and a management team that have done a phenomenal job of growing shareholder value over time. You're getting a natural gas stock at a discount relative to their U.S. peers. U.S. gas names at $4 NYMEX trade anywhere from 5.5 to 7.5 to 8 times cash flow. This company is trading at 4.6 times. And so you get a modest dividend, 3%. It's really the additional free cash flow going back to share buybacks. Plus, they've sanctioned phase 2 of Attachie coming in line in a few years' time. And so you'll get an uplift in terms of free cash flow once that comes online, too. And so we are bullish on the long-term, medium-term outlook for natural gas. We think it is the fuel, not of the future, but the fuel of today, given AI, data centers, mobile power demand, et cetera. And so using what we think are reasonable base case assumptions, we see very meaningful upside in ARC, not just over the next year, but over the next several years.
Okay, so, 20 to 30 seconds, people are responding, of course, to the tariff threats. They're seeing things drop. You're saying it's a lot of noise, but how would you advise investors?
Oil demand remains healthy. Global oil inventories are at their lowest levels, near their lowest levels in history. U.S. shale grew at its slowest pace since its inception. Drill baby drill is absolutely toothless. OPEC has much less spare capacity than what people believe, and it will be largely normalized in about a year's time. Natural gas is now in a multi-year bull market. We now have about a 45% weight towards natural gas in our fund. Free cash flow is massive. Stocks have been walloped on sentiment challenges. Believe what you see, not what you hear from politicians. We remain very bullish in the outlook for Canadian energy stocks.
We got to leave it there, Eric. We're out of time. Thank you for your time. We will see you again tomorrow here on Market Call.
Hi there. Welcome to Commodities. We have a day of turmoil. Now the Ontario Premier Doug Ford says he is suspending his plan to slap a 25% export tariff on electricity going to the U.S. That's after negotiations or talks with the U.S. Commerce Secretary. We'll bring you more on that story throughout the show. Let's see how the energy complex is doing right now. The U.S. Energy Secretary, Chris Wright, says the administration is ready to enforce U.S. sanctions on Iranian oil output, and that could tighten the market. You can see crude has been moving up, but it's been trading near multi-month lows, near the lowest in 6 months. We do have, of course, OPEC Plus and its official plan to add supply, and we also have signs of weakening demand in China, and that's been weighing on the oil market. And of course, we've also got the threat of economic disruption from U.S. President Donald Trump's tariffs. Now, the so-called prompt spread for WTI, which is seen as a key indicator of near-term supply, has held steady in a so-called backward-dated structure in the futures market. Our Bloomberg partners are arguing that's a sign that the economic growth scare for crude isn't as severe as for other assets. They got that analysis from John Byrne, who is with Stratagas Securities. He argues that crude, quote, could be on the cusp of decoupling from other risk assets. So oil showing some signs of life today. Let's have a quick look at gold and silver and copper. In particular, gold is of interest because it's trading near record highs. Again, it's got its snout above that psychological $2,900 level. And we saw record highs today in trading for Agnico Eagle Mines, AEM, in Toronto, and also Wheaton Precious Metals. So investors buying into those names today. Look at that. Agnico, even excluding dividends, has multiplied people's money 4 times over in the past 10 years. And we actually talked to a portfolio manager from Dynamic Funds this morning on BNN Bloomberg, who said, in fact, Agnico has the biggest market cap of any gold company now, because, of course, Newmont and Barrick have fallen out of favor with investors. And there's Wheaton Precious, Randy Smallwood's outfit, also hitting a record high today. Let's check out briefly where the agricultural commodities have been trading. They are down. There's no joy in the canola market, and that's a vital crop for Canada. We know the Chinese have moved to slap massive tariffs on our canola exports to that country, and canola has been trading today at a 3-month low. And, of course, Trump's call for fresh tariffs on Canada, adding to the pessimism in the canola market. Canada, a top producer of that oil seed. Let's get to some other stories we're bringing you in the resource space. Ontario's Premier Doug Ford has agreed to suspend that 25% electricity surcharge on power exports to the United States. He says he will discuss a renewed USMCA deal ahead of the April 2nd deadline that President Trump has set for tariffs on Canadian auto part imports, for example. This comes after Trump doubled tariffs on Canadian aluminum and steel imports, and that's set to take effect tomorrow. There was a meeting involving Ford and the U.S. Secretary of Commerce, Howard Lutnick, or there were talks, and now a further meeting is set for Thursday. The war in Ukraine, and here's some good news, could soon see a 30-day truce. There was a statement on the Ukrainian president's website that said his country is ready to accept a proposal if it's observed by Russia. In return, the U.S. says it will lift its pause on military and intelligence aid for Ukraine. In talks in Saudi Arabia, the U.S. and Ukraine also discussed prisoner swaps with Russia, as well as a potential deal for natural resources. Okay, well, here's a fast-moving story. A day after threatening to impose a 25% surcharge on electricity exports to the U.S., Ontario Premier Doug Ford has agreed to suspend these charges. He's set to meet with the U.S. Secretary of Commerce, Howard Lutnick, to discuss a renewed free trade deal. This comes after, of course, Donald Trump announced that he's reacting to Ford's tariff threat by increasing U.S. duties on steel and aluminum from Canada to 50%. Let's bring in Thomas Timmins. He's head of energy at Gowling WLG. Thank you so much for joining us. It's a moving target. I know it seems to change from minute to minute.
It is indeed. Yeah.
Give us some perspective. So the Ontario sales of electricity to the United States, something like $700 million a year?
Yeah, that's about right. Yeah.
So it's 1.5 million homes. So it's not nothing, but it's not a vast amount of their electricity.
No, that's right. Although we export roughly 90% of the U.S. imports, the U.S. only imports roughly between 1 and 1.5% of its power as a nation, believe it or not. That being said, our system impacts their system. Their system impacts our system. Mm-hmm. They are intimately connected.
Yeah, because, I mean, it's like the auto industry,
exactly.
It's like our food industries, the two are. So would this have been disruptive if the Premier had gone ahead with this thing?
It would have. And you know how you know that for certain, Andy? It got the president's attention. He responded right away, and he responded aggressively. So you know that it would have been disruptive. We don't know to what extent this would have added certainly to the cost. The threat of shutting off Ontario electricity, I think, was a much more substantial threat. Yep. I hope we don't get to that stage. So
yeah, Mr. Ford said, I'll do that if necessary.
Yeah, exactly.
Yeah. Where is this electricity generated, the Ontario Power? Is it nuclear or hydro?
It's a combination of both, plus also renewable assets and gas assets as well. So there's wind, there's solar, there are gas assets, there are gigantic nuclear assets, and then, of course, hydro stations that are our grandparents and great-grandparents built, and they're all across the province. And they've been operating, for some of them, for more than 100 years.
And we typically have a surplus of electricity in Ontario?
That's right. We typically have a surplus, and we typically export into the United States. But that being said, sometimes we import. And that can change from day to day, from hour to hour, literally from moment to moment. So it flies back and forth across the border, and we really do rely on each other to keep our grids stable.
And generally for grids, it's good to share power, isn't it?
It certainly is, yeah. It's good, absolutely good to have neighbors and to work well with your neighbors.
I know we can't get too deeply. Well, you're the man to discuss this with, but who owns this power, if you know what I mean? Who is the legal owner of this electricity?
Well, it's a fascinating question. It's a combination. So Ontario really does have an all-of-the-above energy generating network. And so we have assets that are owned by the public through Ontario Power Gen. We have assets that are privately held. We have assets that are publicly owned but privately operated. We have gas plants that are privately operated. We have wind farms that are privately operated. And often behind those privately owned assets, we have pension funds, life insurance companies, banks, teachers, bus drivers, like all of the above. So Ontarians, in many ways, often own a lot of these assets, either directly or indirectly.
And does the Premier have the power to just say, well, I'm putting an export tax on that electricity?
Well, I would be willing to bet that he's gotten a lot of good legal advice over the past few days. And you've actually seen it. If anyone cares to, you could actually track through the public statements. And the language has been very carefully couched in terms of what's being said. We're dealing with Canadian constitutional issues in terms of what crosses international borders becomes a matter of the federal realm versus the provincial realm. We're dealing with NERC, the North American Electricity Reliability Corporation, something that was established in 1965 after the Great Northeast Blackout of 65.
All right.
All of these reliability standards that we have to comply with. And the one thing that I'm reasonably confident of is that the provinces and the premiers and the various electricity system operators across Canada will comply with their obligations. That's one thing that I'm almost certain of.
It does seem tragic, isn't it? We've been cooperating for decades, and this dispute comes up, threatening to disrupt the relationship.
Yeah, it really is. And electricity is one of those commodities that is really vital. It's really nice to be able to turn on the heater on a cold March morning and to rely on the coffee maker running.
It's what distinguishes a rich industrial society from a developing one, I suppose,
yeah,
a
and
poor
it's
one.
something we have in common with our American cousins.
I know Trump was particularly irate, as you indicated in one of his social media posts. He says it's outrageous they threaten to cut off electricity.
Yeah, so we're going to hear all kinds of, this ain't over, and we're going to hear more and more of that. And Andy, you can't write some of this stuff. I hope we don't go to the brink, literally, with shutting power off, because we really do rely on each other.
Yeah, because that would fracture the relationship for a long time.
Yeah, and that's just the Ontario story. Of course, across Canada, there are all the different grids and different grid operators, and there's a broader story in BC, in Alberta, in Manitoba, and of course in Quebec, which is a vast powerhouse.
Quebec is an even a bigger electricity exporter?
Yeah, and what's also interesting is this is, especially coming out of Quebec, it's all clean power. Right, it's all hydro. And that feeds down into the New England states and really keeps the lights on in places like Boston. So.
We don't want to mess with the Bostonians.
You certainly don't,
the New
yeah.
Englanders, yeah. Thomas, thank you very much for joining us.
Thank you. Good to see you again.
Thomas Timmins, Head of Energy at Gowling WLG. Coming up, so President Trump did say that he was going to increase tariffs on Canadian aluminum and steel effective tomorrow. Now, we heard earlier from the CEO of Algoma Steel. That's after the break.
Gold standard. Gold dust. Pot of gold, solid gold. Golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
At Interactive Brokers, registered advisors work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for Advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Honey.
Honey. NyQuil Complete Honey. Effective cold and flu symptom relief with a dreamy honey taste. NyQuil Honey. The nighttime sniffling, sneezing, coughing, aching, fever, honeylicious so you can rest. Medicine.
0.
No one wants to be a zero, right? You give them two choices in life, be a hero or be a zero. I say don't choose. Zero is hero. It's the most powerful number in the world. There's 6 of them in every million. Questrade wants you to have more zeros, so they've changed the game again with zero commission trades. Now go get your zeros.
It's great to be connected on a plane, but not all the time.
Things are in flux, to put it mildly. Ontario's Premier now says he's suspending his threat to slap an export tariff on electricity going to the United States. However, immediately after he issued that warning, the Trump White House said it was going to hike its tariffs on Canadian steel and aluminum to 50%. Now, I haven't seen any reaction yet to Ontario's delay. Earlier, before all this happened, we sat down with Michael Garcia, the CEO of Algoma Steel, and at that stage, the 50% tariff was still a threat. We began by asking him, in normal times, how much of the company's output usually goes to the U.S.?
In normal times, it's anywhere from 50 to 60% of our order book goes to our U.S. customers.
And you already now, this is such a stop-start thing, you already had put a temporary pause on your shipments and then Trump delayed the tariffs. Are you thinking now you'll have to pause the shipments again?
Well, we're looking very closely at our U.S. Shipments. I know that when we paused shipments for one day in last week, when we had the inclination that the 25% tariff might go off, because remember it was put in place on a Tuesday. I think by Thursday it was back to zero. So by not shipping on Wednesday and Thursday morning, we saved several $100,000 in tariffs. So we'll probably do the same thing tomorrow until we make sure we see the actual 50% tariff rate in the system, so to speak, just to make sure we know what we're dealing with.
And there's an important point here. I think it applies to you and many other Canadian exporters. You are also the importer of the steel into the United States, so you're on the hook for the tariffs?
Correct. We're the importer of record, so we have the obligation of paying the tariff, and we do that based on the sales price of the material and the timing of when it crosses the U.S. border. So, getting anything across the border before the 50% tariff is officially in effect is very important because we are about to go from 0 to possibly 50% in the next several hours.
Are you trying right now to get as many trucks south of the border as you can?
The border is about 300 meters to my rear, and I'm sure any trucks that we have ready for a U.S. customer, I sure hope is crossing as we speak.
At what point does it become just uneconomic or impossible for you to actually sell steel into the USA? You just won't be able to compete.
Well, if we want to compete and make a margin, make a profit to attract shareholders, to attract the type of cash and generate the type of cash for future investment, future growth opportunities, rewarding our shareholders, rewarding our employees, rewarding our stakeholders. I think, a 25% or a 50% tariff already significantly impacts that. If the discussion is more, can you stay in operation and pay the light bill, so to speak, then it's a larger number. And it all depends at the end of the day on the underlying price of steel. We know since Inauguration Day, steel in the U.S. has risen over 30% in sales price. So obviously an increased sales price certainly helps.
Right. It's hard to find good news here, but that eases the pain a bit for you if you do go on selling steel into America?
Correct. But obviously, we aren't in operation to simply survive. We want to thrive. We're implementing our new electric arc furnace. We'll be producing electric arc steel in a matter of weeks. That's a fantastic transformation for the company. We'll be lower cost, we'll be more flexible, we'll be a greener company. So we are on the verge of a significant transformation in the company, and those are all very good signs, and we hope that the current uncertainty and volatility gets worked through.
At midnight tonight, where will your tons actually start going if they're not going to be going to the U.S.?
Well, we have an opportunity. Half of our order book, and it's probably more than half most recently, is to our Canadian customers. We know that at a large 50,000-foot view, Canada consumes 16 million tons of steel, and almost half of that, or a little over half of that, is supplied by foreign steel makers, China, the U.S., and others. So, we're calling every Canadian customer. If there's one appeal I would make, is if there's a Canadian user and buyer of steel and they aren't buying Canadian steel, please give Algoma Steel a call, because we want to be your supplier.
Could you remind us, what are the main products you make? For example, is the auto industry important to you?
Certainly. We make flat rolled steel products. So we sell steel that goes into the automotive supply chain for the internal parts of cars, frame rails, skid plates, other durable parts of automotive frames and assemblies. We make steel for the oil country tubular goods. We make steel for manufacturers of durable goods like cement mixers and garbage trucks. We make steel for people building bridges. It's really across many sectors of the economy.
Have you been on the phone to any of the Detroit car makers, automakers today? Have they given you any indication as to whether they would be willing to pay more for your steel?
We have frequent and ongoing conversations with all of our steel suppliers. We have a pretty large amount of inventory co-located right near our automotive customers in just-in-time industry, because you have to have a just-in-time inventory, because you have to have 100% promise delivery to those type of customers. So we've had those type of discussions. They are trying to understand what the impact on their supply chain is going to be as certain sub-assemblies or finished automobiles cross the border. So I'm sure they are working through many of the same issues and dealing with the same uncertainty that we are.
At what point, and I'm sorry to strike this note, but at what point would you have to start shutting down operations in a significant way?
We're a long way from that. We're right now, because we aren't yet making electric arc furnace steel, we are blast furnace steel producing, so it's quite a significant and costly endeavor to pause a blast furnace and protect it and send the people home. So we are looking at redirecting as much of our business as possible into the domestic market, the Canadian market. I think there's certainly things that the Canadian government can do to strengthen that market and shut out that market, or make it much more difficult for this foreign steel to have such a large percentage of the Canadian domestic market. And we also appeal to Canadian producers and Canadian users of steel to buy Canadian. So that's where our focus is, and I think that's where the focus will remain. We're a long way from having to take a decision to shutter operations or pause operations for any length of time.
What do you want the federal and provincial governments to do right now?
Continue doing what's best for Canadians. Continue to try to engage with the Trump administration to try to understand if there's common ground where we can solve a problem. It's disheartening to see almost negotiation, or if you want to call it a trade war. I hate using that word because war is a very serious term to use. But it's really disheartening to see it played out, via tweet or, shot, counter shot, shot, counter shot. I would much rather it happen at a table discussing all the aspects of the North American trade and how can we continue to make North America a fantastic trade environment for the United States, for Canada, and for Mexico. That's what happened in 2018 after the 2018 tariffs. It took 10 months to come up with a negotiated USMCA agreement, which I believe President Trump called the best trade agreement ever. I think to the extent that trade in North America can continue to be worked on, and each country's issues with free trade and problems with the current trading environment can be addressed in a productive manner that leads to prosperity, fantastic jobs, and fantastic opportunity for everybody in the United States, everybody in Canada, and everybody in North America. I would hope that we can get to that type of ongoing dialogue and back and forth rather than it happening, in the way it's been happening the last week or so, which makes it very disruptive and difficult to deal with.
And just a reminder, we talked to the Algoma CEO before Ontario backed down on the electricity export tariff, and now President Trump says he's considering walking back his 50% tariff on Canadian metals. We'll have more after this.
Gold standard, gold dust, pot of gold, solid gold. You're worth your weight in gold. Golden boy, golden girl, golden goose, golden egg, golden age, golden ticket, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
A lot of valleys, I've seen a lot of peaks. I've seen the bitter with the sweet, victory and defeat. Sometimes I fell, but a voice kept saying, son, stick to your vision. Keep the composition. Seen a lot of shame in the game.
Donate at lovescarborough.ca.
Did you know cold viruses often start in the nose before they spread and make you really sick? Try Vicks Early Defense Nasal Spray. When used at the first sign of a cold, Vicks traps, blocks, and removes cold viruses at the source. When you can't afford to get really sick, always have Vicks Early Defense Nasal Spray on hand.
Oh, my Wi-Fi. I have an internet intolerance. Gives me rashes. You have fishnet?
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Closed captioning of this BNN Bloomberg program is brought to you in part by Scotia iTrade. You have what it takes to start direct investing. We have the rest. Scotia iTrade.
Let's get more on this back and forth on electricity and metal tariffs. Now President Trump says he's considering dropping that plan to put a 50% levy on Canadian steel and aluminum. Let's get more from Bloomberg metals and mining reporter Joe Doe. Joe, thanks for joining us. A moving target here, this story.
Yeah, as you said, Andy, I mean, we had a post from the President of the United States this morning saying he was going to ratchet up the steel and aluminum tariffs that are supposed to go into effect tonight by doubling them on Canada. And of course, just a few minutes ago, he said that he's going to back off of that for now. So I think this is more of the same of what we've been hearing from traders in the market now for weeks on the metal trade in particular, saying that the information flow from the White House is coming out so fast and furious that it's incredibly difficult to trade in these markets. And it's been really hard as well on consumers of the actual metal, right? So much uncertainty is just leaving a lot of people on the sidelines.
Unbelievable. And the disruption, though, a 50% levy on metals, I mean, that would just push a lot of our exporters out of the market, essentially.
It would be brutal. I mean, as you've said, as you had the Algoma CEO saying that they would be looking at more Canadian buyers. I think the aluminum one is a massive question. What would actually happen to all that metal? It would become prohibitively expensive for American buyers. Maybe they would start looking to other regions of the world. Either way, I do think kind of this pullback that we've seen, it might indicate the many problems that a lot of the market were trying to, trying to express to the White House, to the Trump administration, to others.
Joe, we'll have to go. I wish we had more time with you, and thank you very much indeed for joining us. That's Bloomberg Metals and Mining reporter Joe Doe. Thank you very much indeed for watching Commodities. Going to hand you over to the close after this.
Just close the doors, and you're in a world of your own. Travel is not just about the destination, it's also about how you get there. Fly Emirates. Fly better.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
Interactive Brokers pays up to 3.83% on instantly available U.S. dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.83% on uninvested, instantly available U.S. dollars in your brokerage account. The best informed investors choose Interactive Brokers.
Practice starts in 20. Let's get it. T-Mac.
Who shaves for practice?
My game face doesn't take days off with Gillette Labs.
Gillette Labs?
Gillette's ultimate shaving experience. Its green bar releases trapped hairs so you can get virtually every hair in a single stroke, reducing irritation from shaving over the same spot.
You looking smooth, brother.
Let me hook you up.
Appreciate that, kid.
Best your game can get.
Keeps getting better.
Gold standard. Gold dust. Pot of gold. Solid gold. Golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
You're watching Close on BNN Bloomberg. I'm Morella Fernandez. 30 minutes now till the end of the trading day. Let's get to some of the stories we're following out of the BNN Bloomberg newsroom. The Ontario Premier Doug Ford suspending that 25% electricity surcharge for exports to the U.S. and says he will discuss a renewed CUSMA deal ahead of the April 2nd deadline. The U.S. President Donald Trump now says he may reverse course on that threat to double tariffs on Canadian steel and aluminum in response. A meeting between Doug Ford and the U.S. Secretary of Commerce, Howard Lutnick, is scheduled for Thursday. Washington will soon require some Canadian travelers to register in the U.S. if they plan on staying for more than 30 days. The draft rule, which is set to take effect April 11th, would require travelers to submit fingerprints and create an account with the American government. The rule would exclude those under the age of 14, and those over 18 must carry proof of registration, they say, at all times. A new acquisition has been announced in the Canadian pharmaceutical space. Knight Therapeutics agreed to acquire Paladin Pharma for $120 million, with $20 million worth of inventory also included in that deal. Knight CEO saying the acquisition will help fund growth in Canada and Latin America. The deal expected to close mid-year. Couche-Tard says it will keep up what it calls friendly and persistent attempts to acquire the parent company of 7-Eleven. Couche-Tard says it has financing in place and sees a clear path to gaining antitrust regulatory approval in the U.S. Couche-Tard also says it continues to be disappointed that engagement from 7 & I Holdings has been, quote, very limited. American Airlines says it will have a larger first quarter loss than expected as it deals with weak travel demand and fallout from a fatal collision involving one of its planes. Actions by the Trump administration, including federal job cuts and the trade war, are leading some Americans to reconsider discretionary spending like travel. Let's take a look at how the American markets, or the Canadian markets first, are doing. The TSX Composite down by 89 points today. That is a drop, but not as much as yesterday. Still in the red, or down up 11.7 over the year. Well, the sell-off continues on Wall Street today with the escalation of the trade war. Both the S&P and the NASDAQ are nearing correction territory, meaning they've almost dropped about 10% since the start of the year. Let's talk about everything that's going on with a market check with Jed Ellerbrook. He's large cap portfolio manager at Argent Capital. Jed, thanks for joining us today.
Hey, thanks for having me.
Even as we speak, things are changing, we know, in that trade war. But what's your big picture take on what seems to be a daily upping in the ante of the trade war?
Yeah, the market is volatile right now, which is a fancy way of saying that things are not going terribly well. The stock market doesn't particularly like the tariffs, doesn't particularly like the jumping back and forth, announcing this, revoking it a day later. Doesn't particularly like the fiscal austerity measures that the Department of Government Efficiency is enacting either.
There are a lot of nervous investors out there. As you know, they can't sort of plan forward because of all of the uncertainty, as you say. The NASDAQ and S&P are almost in correction territory. Can you focus in a little bit on those two markets and tell me what you see?
Yeah. Within technology stocks, we see a lot of great stuff going on. The advent and application of artificial intelligence tools is disseminating across enterprises. There's so much investment in data centers and new AI tools. So we think that's all a really big positive for the market, albeit overshadowed, for the moment by all of the kind of political stuff and things that we're reading about every day related to, tariffs, et cetera. But we think, looking out 6-9 months, we're pretty optimistic.
Do you worry about overvaluation?
Maybe 2 months ago, but today, after pretty steep sell-offs in a lot of those stocks, for example, NVIDIA down, almost, 20 to 25% over the last couple months. Microsoft, not quite as much, but, large declines. Same with Amazon, for example. We're pretty comfortable with large tech valuations today in all but 1 or 2 cases. Tesla's too expensive for us still. So is Palantir, but for several of them, we think things look pretty good valuation-wise right now.
Okay, so let's talk about some of the stocks where you think there is a either buy opportunity or a time to shelter as an investor, because you still like Amazon. Tell me about that.
We do. Amazon is our largest holding in the Argent large cap strategy. At Argent, we're investing based on a 5 or 10-year outlook. And we particularly like Amazon because we think that both of their businesses are exceptionally well positioned to succeed. The retail business is one of, really 3 large retailers in North America that's actually growing materially their sales. Amazon, Walmart, and Costco is the third. Amazon getting the lion's share of that growth. And then we really like their AWS business, which is, the world's largest cloud computing business. They're benefiting from enterprises moving workloads from on-premises to the cloud, and then also, the use of these AI tools, which often require data to be in one place, and that one place is most often the cloud.
Do you worry about anti-American sentiment that seems to be growing in some pockets? Do you worry about a sort of pushback the way we're seeing Tesla under Elon Musk?
Yeah, it's an incremental negative.
Okay, so you're worried about it, but you're not that worried about it.
Yeah, we're worried about it, keeping an eye on it. Didn't necessarily expect it to come about the way that it has, and hope that it doesn't last.
Okay. Tell me about Progressive Corp. What do you like there?
Yeah, we think Progressive is the Jordan Bennington of Argent's large cap strategy. And just like Canada's favorite goaltender and St. Louis Blues goaltender here in our hometown, it's the best defense money can buy. And you want defense in your portfolio in uncertain times like this. We particularly like Progressive because everybody has to buy auto insurance, whether the economy is growing or whether it's not growing. And so we like that kind of defensive stability. And then on top of that, Progressive is gaining market share against really all of its large peers. And I'm thinking of Allstate, State Farm, Geico, Liberty Mutual, et cetera.
Okay, let's talk about NVIDIA, because that is a stock, again, that has taken quite a hit. There was a DeepSeek thing. People rebounded after that, and we're still sort of interested, and now it's waffling again. So why do you like NVIDIA sort of long-term?
Yeah, we think that they have a dominant position in accelerator semiconductor chips. The company's spending $16 billion a year currently on R&D, mostly related to these data center chip efforts. That dwarfs all of their peers. So, much greater investment, much greater commitment, combined with their dominant market share, today, is going to make them really, really difficult to compete with. And so, yes, Amazon, Microsoft, Google, OpenAI, even Apple are all developing their own internal accelerator chip efforts to try to compete with NVIDIA and reduce their dependence on NVIDIA. So far, those internal efforts haven't really approached NVIDIA's quality, and we do not expect that to change over the medium term.
All right. You also like Walmart. We talked a bit about Amazon and its model of shipping to people, and you see some growth still there. I'm just wondering, with Walmart, is this sort of taking into account a trade war or taking into account a recession where people are relying on their staples and that's where they're going to go?
Yeah, we do not own Walmart in Argent's large cap strategy, but you need to acknowledge the company has performed really well. They've made a lot of investments in online fulfillment and ordering, and they're benefiting from consumer trade down, with people being a little bit more cost conscious here over the last year.
Okay, Jed, I do have to leave the conversation with you there. I'm out of time, but thanks for your time today. Appreciate that.
Have a great day.
Coming up next, we'll discuss how and if today's escalation in the Canada-U.S. tariff war could impact the Bank of Canada's rate decision. Of course, that comes down tomorrow. We're back in a moment.
The Close is brought to you by Emirates. Fly Emirates to Dubai and beyond to over 140 destinations from Toronto and Montreal. Fly Emirates. Fly better.
Helium Evolution. Advancing Canada's quest for a critical mineral essential in today's most advanced technologies. With helium demand forecast to explode by 70% over the next 15 years. A land position of over 5 million prospective acres in Saskatchewan, among the world's cleanest helium producers. And an ongoing development program in partnership with the industry's largest producer. One company is poised for significant future growth. Helium Evolution. Unlocking Canada's helium potential.
Earn more from investing in Canada's largest banks and life co's. Get high monthly income and enhanced returns with SBC and LBS. Over 15 years of proven performance. SBC and LBS on the TSX.
I love that my daughter still needs me, but sometimes I can't help due to pain in my hands. So I use Nervive Nerve Relief.
Its dose of ALA helps relieve pain associated with peripheral neuropathy, with results starting in 14 days.
Now I can help again. Feel the difference with Nervive.
At Interactive Brokers, registered advisors work with the best research and trading tools designed to help them outperform the markets. Meet them at Interactive Brokers Investors Marketplace for Advisors. Advisors at Interactive Brokers keep all they earn on our low-cost platform, with no ticket fees or custody charges, low margin rates, and high interest earned on idle cash. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
Gold standard, gold dust, pot of gold, solid gold. You're worth your weight in gold.
Golden boy, golden girl.
Golden goose, golden egg, golden age, golden ticket, golden opportunity. Is it just me, or is there some kind of clue here? I don't know.
We've been talking about the escalation in tariff tension between Canada and the U.S. We've been talking about that for days. Could the prospect of a prolonged trade war weigh on the Bank of Canada's interest rate decision, which comes out tomorrow? Let's join Pedro Antunes. He's the chief economist at the Conference Board of Canada, and Etienne Bordelot-Lebrec, vice president and portfolio manager at 9 Point Partners. Both of you expect to see a 25 basis points cut by the bank tomorrow. Pedro, I'm going to start with you. Tell me what's built into your expectation.
Well, I think essentially the bank feels that the economy is in excess supply. We've seen labor markets and unemployment rates coming up. Certainly the economy has been quite strong in the last quarter, but I think with the sense of what's coming, the concerns over tariff wars, but even the fact that, there's a lot of anxiety and uncertainty about the tariffs themselves. I think that's already causing, consumer confidence come down, certainly business confidence. So I think just in the environment that we're in, for the bank to continue on its path of lowering interest rates, I think is possibly the path they want to be on.
Okay, Etienne, I want you to factor in as well why you think a 25 basis point cut. And I want to pick up on something Pedro said. He's talking about confidence and the lack of by consumers and businesses. I want to push it further and say with all of the changes minute by minute, it's almost more of a panic. I mean, what do you do if you're a business owner? How do you build in to looking forward to a rate cut and what it's going to be?
Yeah, so I don't think you can factor this into your decisions as a business owner, as an individual. It's just always changing and there doesn't seem to be a clear direction. I think the Bank of Canada, as Pedro said, it's pretty clear that with all this uncertainty, the path of least resistance is a rate cut. Yes, the data has been coming in strong in Q4. I think there's two kind of one-off things that have been pushing the data to be stronger. One is the HST, GST pause that we had. So I think some of purchasing was brought forward because of that. And also the threat of trade wars. We've seen the December and January export numbers in Canada have been very strong. So I think there's been some building up of inventory south of the border in preparation for the trade war. So we need to see maybe March and April data before we can conclude that Q4 was really as strong as it seems. So put it all together, excess supply, weak employment, plus no confidence as to what's going to happen on many fronts. I think it's clear that the bank needs to be stimulative, not neutral or restrictive anymore.
Okay, so Pedro, is anybody even thinking about Ottawa's support packages at some point, if those are needed? They've already hinted that, they're open to that. That being said, we're going to have an election, very likely, according to Mark Carney, who's been picked as the new Prime Minister, new Liberal leader. So do you even begin to factor that in?
Well, yeah, I mean, it's just such an uncertain environment. We're building our forecast currently. We've just got the national accounts released, and so that starts our forecast cycle. And, every day we're positing whether we've got the right assumptions in there. I think still the tariff war and the trade war, this is the biggest piece affecting the economy. And again, even if we don't see all-out tariffs across the board, which I'm not sure we will see, I think we keep seeing hesitation around that. And I think the ultimate end game here for the Trump administration is to create this sense of uncertainty, this anxiety. It's a bullish tactic, but it really on its own, without actually applying the tariffs, moves investment south, just because, businesses in Canada want to have access to the U.S. consumer. So, but yeah, I think definitely we are going to see some tariffs. We'll know tomorrow if we see those steel and aluminum tariffs being put in place. We'll have to wait till, another month to see if we're going to get hit with more. But I think all of this generates a sense that we're going to see very weak first, second quarter of the economy for Canada and for the U.S., by the way. And we're seeing that reflected in stock markets. They're getting hit just as badly south of the border as they are here.
Okay, let's circle back for me, Etienne, on the idea that the trade war is not necessarily going to be a trade war, but really just a tactic to get Donald Trump where he wants to get in negotiations or luring companies to America. Do you agree? Yeah,
I think that's we've heard from Commerce Secretary Lutnick many times. We've heard from Treasury Secretary Bessent as well. They lump a lot of different things together, but I don't think this was ever about illegal drugs and fentanyl. This was always about creating enough uncertainty that businesses do not want to commit to invest in Canada or Mexico, move business to the U.S. They keep talking about this golden age, this manufacturing renaissance, that they want to see all these jobs back, this utopia of going back to the 1950s. They just can't get there. It doesn't work because they consume a lot more than they produce. So there's no way that America, with a jobless rate around 4%, can bring all these jobs back and bring all these manufacturing jobs back to the U.S. So there's this tension inherent in this vision that they have that is not really achievable. So I think they're going to have to drive their own economy into recession to find out. Okay, Pedro, do you agree? Because Trump has been flirting with that pause, he calls it, in the economy. Do you think that there will be a recession in the U.S. and that'll sort of prompt or trigger some other action?
Yeah, I mean, we're very worried, obviously, and I think it'll depend a lot on the end game. Like, is it really just to move that investment, just to get some of those manufacturing jobs that the U.S. has lost? They want to see that reinvestment happening. Or, do we really see a situation where I think the other scary piece is fiscally, the U.S. is running a deficit that's going to run around 6% of GDP. The debt load is very high. Are the tariffs really a measure to, essentially bolster their revenues? And if that's the case, that's very concerning. So I think a recession is definitely in the cards. We're probably going to see a second quarter that could be negative if any of these tariffs are applied. And remember, the U.S. is threatening not only Canada, but in fact, Canada, Mexico, and tariffs against China all at the same time. So this puts the U.S. economy in a really precarious position for the start of this year. What else can we say? I mean, there's just so much uncertainty around that I think if we do see these kinds of tariffs applied, an economic slowdown, likely we are going to see some of these support measures come in to try and help with the downturn. How low do you think the Bank of Canada could or would consider going, given the current climate? I don't think that they want to go back to the zero lower bound and restart QE. I think that unless things get really ugly, I think that's out of the question. So the bottom end of the neutral range that they provide us is 2.25%. So anything that's below that would be stimulative. So we see them going under 2%, somewhere between 1.5% and 2% by the end of this year. This is our kind of forecast, contingent on all these uncertainties that we're talking about. And if this you said really ugly. What is really ugly to you? Well, if the tit for tat that we've seen over the past week and a half continues to escalate, these numbers just get doubled every day. Who knows where things could go? President Trump doesn't seem like somebody that likes to back down and look like he's losing. And our leaders have done the right thing, I think, that calling their bluff and going real on the tariffs, because the U.S. administration just seemed to like this idea of keeping them over our heads, but not actually implementing them and feeling the full force of them. But if we keep going like this, this might become a little bit more tricky. Pedro, same question I want to put to you. Do you think, or how low will the bank go this year, given what's going on? How low do you think they could or would go? Well, I mean, our thinking right now is that we'll see some sort of tariffs applied, some sort of retaliatory tariffs from Canada, and we're essentially building in just a 1 quarter hit to the economy, and a 1 quarter hit with tariffs to the economy. That's long enough, if you ask me, and that's going to be very, very stressful for a lot of industries and businesses in Canada. In that scenario, we felt that we essentially don't see the Bank of Canada necessarily using expansionary policy, as Etienne just mentioned. In other words, we see the bank kind of coming to the neutral rate, sticking it out for a little bit, and taking a wait-and-see approach. And that's partly because tariffs are very inflationary as well. And so you get into this situation where you're fighting a low dollar to begin with, possibly the impact of of tariffs on inflation at the same time as you're dealing with a weak economy, but that's hopefully supported on the fiscal side instead. If we do see tariffs, instilled in a permanent way or something that's longer duration, then we're talking full recession. We're talking about an economy that goes essentially negative on the year, and there we could see much more stimulative interest rates. In other words, going into that territory of below inflation, let's say, maybe even something like we saw during the pandemic.
Pedro and Etienne, appreciate you both joining us today. Thank you very much for sharing some of your time.
It's been a pleasure.
Thank you.
All right, let's get to this news. The Ontario Premier Doug Ford suspending that 25% electricity surcharge for exports to the U.S. We'll tell you more about that when we come back.
At Capital Group, as one of the world's largest active asset managers, we craft our funds with care. Our portfolio managers, researchers, and analysts collaborate, striking the perfect balance between adaptability, strength, and endurance. And that includes our new suite of active ETFs. It's this hands-on approach that sets our investments apart, so they can make a difference where it matters, the core of a portfolio. They're meticulously crafted to endure. Capital Group, actively different.
The world of investments is growing, offering more alternatives than ever. Choose an alternative that invests in what's here to stay. Things you can see and touch. Things that are part of our everyday lives. Avenue Living brings a different approach. One that's steeped in history, experience, and trust. Choose a proven alternative. Talk to your advisor about Avenue Living today.
Practice starts in 20. Let's get it. T-Mac.
Who shaves for practice?
My game face doesn't take days off with Gillette Labs.
Gillette Labs?
Gillette's ultimate shaving experience. Its green bar releases trapped hairs so you can get virtually every hair in a single stroke, reducing irritation from shaving over the same spot.
You looking smooth, brother.
Let me hook you up.
Appreciate that, kid.
Best your game can get.
Keeps getting better.
Do you need financing for your business? Get up to $800,000 in less than 24 hours from Merchant Growth. Apply online today and get your no-obligation quote. Trusted by over 10,000 businesses, Merchant Growth is Canada's leader for convenient business financing. Apply now at merchantgrowth.ca.
Looking for a new investment? Meet Mulvihill Split Preferred Share ETF, where your income is stable, reliable, consistent, and monthly. Strategically enhance your income with the highest yielding Canadian Preferred Share ETF, Mulvihill.
Nanos polling numbers show the gap between the Conservatives and Liberals has narrowed. For more on that, let's go to CTV's Colton Prale. Colton.
New polling from Nanos Research showing a very interesting situation, Morella. Just 1 point separating the Liberals and the Conservatives. In the last round of polling, it was about 2.5 points. A month ago, it was 16 points. This is a dramatic tightening of the gap between these two parties. But how much of it is Mark Carney? How much is he credited with this closing of the gap? Because this round of polling only goes up to March 7th, and he wasn't officially the Liberal leader at that point in time. In the same polling, we see that Donald Trump and U.S. trade relations are the top issue for Canadians. And in all of this, Justin Trudeau's favorability just hit a 12-month high. So how much of this is Mark Carney coming in as leader? How much of this is the overarching international situation and the response to it from the Canadian government, a response that has been largely fronted by the man who's seemingly as popular as he's ever been in the last year, Justin Trudeau? And if it is to be credited to Justin Trudeau, will that surge in support that we're seeing in the polls continue? Will it transition to Mark Carney as he starts to front that response? It's a big, big question, and if I'm a conservative strategist, Morella, this is where I'm trying to dial in on. Is there an opportunity to regain some of that lead when Mark Carney takes over those communications, when he introduces a new cabinet? Can we assert ourselves as a party? And if I'm Mark Carney, I'm looking to keep that momentum going. I'm looking to continue to put forward a strong response to Donald Trump, try to capitalize on the momentum that has been building up and move forward from there. Of course, to do that, he needs to be named prime minister. He needs to name a cabinet, and that is expected to happen very shortly. We heard him say it was going to be soon yesterday. A smooth and efficient process is what he said it would be. There was talk it could happen as early as today. His team has told me that will not be the case, but I would expect over the next couple of days we are likely to see that, and then just after that, likely some point next week, but certainly within the next 13 days, we're probably talking about an election being called. It's highly unlikely that the Carney camp allows this to go all the way to March 24th, when we would see the House of Commons return. It's almost certain that we're going to see the writ drop prior to that. Watch the polling to see just when might be the most favorable moment. Morella?
CTV's Colton Prale, thanks for that. Coming up next, the closing bells on Bay and Wall Street.
Gold standard, gold dust, pot of gold, solid gold, golden opportunity. Is it just me or is there some kind of clue here? I don't know.
You've got a Pepto predicament, Ace. You overdid it on your poutine routine. Undo it with Pepto Caplets.
When you have nausea, heartburn, indigestion, upset stomach, diarrhea.
When you overdo it, undo it with Pepto-Bismol.
It happened on March 9th at 6:17 p.m. Gathered was Marco with his dog Minnie, curling champs the Mouthies, and content queen Quinn. So how did the never-available host Julie make the unplannable happen? With Samsung Galaxy AI on Bell.
I just took a shower above the clouds. You know why? Because this is the Emirates A380.
Looking to maximize your monthly income? Our Yield Maximizer ETFs combine your favorite sectors with a high-yielding income-first strategy to help you meet your goals. More income every month from Hamilton ETFs.
No matter what kind of teeth you gotta brush, Oral-B Electric cleans better with one simple touch. Oral-B's dentist-inspired round brush head hugs them, cleans them, and gets in between them for 100% cleaner teeth. Your perfect clean routine starts with Oral-B.
You are one with the rod and pipe. You are the golden arm.
I need a minute, I'm meditating. That's not meditating. I just heard your weird self-recording.
It's the end of the trading day, the start of the after-hour session. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we close today on Bay and Wall Street. Yeah, it was quite a blowout yesterday, so let's see if we had a bit of a comeback today. The TSX today still down 134 points, or about 0.5%. Let's get to the S&P. It dropped by 42 points today, 0.76%. 17,436 is where we end the day. On the NASDAQ, it was down by 32 points. So the NASDAQ and the S&P were actually flirting with correction territory today, which means they were down almost to that 10% mark from the start of the year, more than 9% and change, but each of them having a drop still by the end of the day. Let's take a look at the Canadian dollar and see how we did there. The Canadian dollar ended the day at 69.39, so again, still under the 70-cent U.S. mark. Let's take a look at the big moves of the day on the TSX. Gainers include Aya, which was up more than 15%, as well as IM Gold. Precious metals were gaining as investors run to safer assets, and that's what's driving the top movers to the upside today. Let's get to Capstone. Copper. JP Morgan initiated coverage on Capstone Copper with an overweight and 12-month price target of $10.80 today. It ended the day at 7.56. Let's get to the losers on the TSX today. Tilray Brands shares are down on a $15 million debt for equity transaction. Now, BRP yesterday, TD Cowen cut the price target for the CD maker to $70 from $83, clocking in today $56.33. And Imperial Oil CEO Brad Corson said to retire that stock down today to $95.79 or 4.13%. Let's get to the decliners on the S&P. Delta, Airbnb, Expedia leading the sell-off in travel stocks because of consumer worries. S&P 500 gainers include Supermicro, rated buy at Rosenblatt Securities due to competitive advantages, and the firm gave the company a $60 price target. Southwest Airlines, the airline cut its revenue forecast, accelerates buyback, and announced it is ditching free checked bags like a lot of the other airlines. CrowdStrike, it unveiled major expansion to an accelerating partner program aimed at enhancing collaboration and profitability within the cybersecurity industry. All right, for more on stock movers today, let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now. Stephanie, what's going on with Magna International?
Hey, Marilla. So Magna is one of the worst performers on the TSX today, and it really shouldn't be surprising that an automaker like Magna and some of its other peers are underperforming today, just given a lot of the tariff news that we keep talking about. So in Magna's case, those shares fell by over 5% at its lowest point. It wasn't its biggest intraday drop this month, but it's all couched in that auto tariff theme that has been dominating headlines. So that story really heated up earlier today when Donald Trump said that he would substantially increase auto tariffs on April 2nd after Ontario put a 25% surcharge on electricity, adding that his tariff would basically permanently shut down the car manufacturing business in Canada, which is a pretty bold statement. In that same post, he said he would double the tariff on Canadian steel and aluminum to 50%. Now, there was a degree of walking back, at least as far as Doug Ford goes. He says that he said earlier today that he would pause the surcharge on electricity as he is speaking with Lutnick and plans to meet him in Washington later this week. But that didn't really bring the auto parts makers back into the green. They did reverse some of the losses there, but other auto names like Linamar and Martin Rea were also in the red. And I guess we're just going to have to get used to hearing those names because this tariff story isn't going away anytime soon. But Magna being the largest, that also was the hardest hit today, Marilla.
Okay, so let's talk about where people are fleeing to as a result of all this chaotic movement back and forth in the trade war, and they're going definitely to the metals.
Absolutely, yeah. So the same environment that is weighing on autos is giving a boost to precious metals like gold and silver, and you really saw that play out with Aya Gold and Silver, like you alluded to coming out of the break there. So that those shares are jumping by over 18%, or yeah, 18% at its highest point, and that was its biggest intraday jump since May 2022. So it's been a while since we've seen Aya really get gains like that. Investors, like you said, have been flocking to safe assets as they're trying to figure out what's going on in the broader market. And there's really been no shortage of uncertainty lately, given the tariff headlines and the markets coming under pressure in other areas. There's also just been this rotation out of tech names into hard assets, which makes sense as you see the price of gold really start to grind higher, even further higher, coming over the $2,900 mark as traders are weighing the outlook for the U.S. economy, especially after Trump's comments that remarked that it could suffer some blows as he's reshaping tariff and potentially trade policy there. So it wasn't just Aya there. There were other TSX listed names such as IM Gold, First Majestic, Orla Mining, New Gold, Mag Silver, a few other precious metals names that are gaining today. And that's been just a consistent story this year and at the back end of last year. So top 10 TSX performers were pretty much all precious metals names today, Morella. It was a really interesting dynamic to see. And like I go back to, it makes sense. There's just not a lot of safe places on the markets right now.
Yeah, people are definitely trying to find them and get there. Bloomberg's equities reporter, Stephanie Hughes. Stephanie, thank you. Appreciate that. All right, coming up next, we'll talk a little bit more about all that trade war stuff from today, who's backtracking, who's moving forward, and take a deeper look at the markets and what's happening there. We're back in a moment.
Eric Gorman is the VP of Operations at Capital Direct. What's the latest?
Well, I'm back with more good news. In 2024, Capital Direct One Income Trust beat analyst predictions as our return trended upward. Our Class F unit hit 10% annualized return, and our Class A and C kicked out over 9%.
Those are impressive numbers. How do they compare to historical returns for the fund?
Yes, 2024 was a good year, and that's in line with our track record. We've been in the market for 19 years now, and we've continued to kick out consistent, stable returns for our investors with a low standard deviation.
And what's the growth rate for the fund over several years?
Over the last 10 years, the number of accounts holding the fund has increased by over 1,000%. Also, the trust assets have grown over $500 million. We believe this growth shows the trust that both individual investors and financial advisors have in Capital Direct One Income Trust.
What does the fund offer investors as far as flexibility?
Well, to start, monthly liquidity opportunities. And then in regards to our quarterly distribution, some people take it as cash, so see it as an income vehicle. Others take advantage of compound growth by opting into our automatic DRIP program. I would say the DRIP is the most popular. For most investors, it's a set it and forget it scenario.
And can people change if they want the cash or reinvestment option?
Yes, we realize that people may need access to their distribution, whether for a family event, a down payment, or even to satisfy a minimum RIF payment. They or their advisor can opt back into the DRIP program at any time.
And where can people find out more?
So we are registered in every province throughout Canada. People can find us online at incometrust1.ca or call us directly 1-800-625-7747.
We've got a trade war, a lot of uncertainty. Investors are wondering what to do and where to go. Let's bring into a conversation Ian DeVertide, Managing Director and Head of Portfolio Strategy at CIBC World Markets. Ian, thanks for joining us today.
Thank you for having me.
Do you have whiplash? Because I've got whiplash definitely just in the afternoon today.
Yeah.
So what do you do with this changing story that seems to be constant? What are you telling your investors?
So the big line I use with my institutional investors is, if you're not confused, you're not paying attention. The reality is there is an underlying strategy to what the president is trying to achieve. And the strategy was quite effective in his first administration. It was to create a degree of uncertainty that lowers the discount rate on investing in America and raises the discount rate on investing anywhere in the world. And that exists simply because if you're unclear on what the tariff situation is and the ability to move goods in an unfettered manner between Canada and the U.S. and other countries in the U.S., then it's more likely you'll invest in the United States. That is the going-in position. That's the simple approach to it. Unfortunately, I think there is so much of that uncertainty I perceive, and certainly the feedback we're getting from C-suite executives is they are frozen. They're not sure what to do. Even the idea of, let's say, build in America, you would say, well, hold on, I don't know input costs on my factories because I don't know the price of steel and aluminum coming in. I don't know how many workers I'm going to find because they have a relatively low unemployment rate, and it looks like ICE is becoming quite active with a variety of immigrants. And last but not least, we believe there's going to be tariffs on goods coming in from Mexico, which has a material wage advantage versus the U.S. So what's even a U.S. C-suite executive supposed to do? That's the reason why we have been arguing for a few months now that investors need to be extremely defensive, they need to raise cash, and they need, in their positioning on the equity front, to own very stable, high dividend-paying Canadian equities, which will allow you to carry in this environment. Sorry, didn't mean to cut you
I'm so
off.
glad that you mentioned the paralysis by those who have to make those decisions, because Donald Trump thinks you're all going to throw down and say, you're right, let's go to the U.S. and we'll be protected there and things will be great because we won't have a lot of regulation. But really, this sort of whiplash idea makes everybody just stop because they want the whiplash to stop, right? They want to know what's going to happen. You mentioned that there are certain sectors you can look to. Let's talk a little bit about what those sectors are, because right now, when you look at lumber, when you look at dairy, steel, aluminum, anything involved in vehicle manufacturing, you are wondering what lies ahead.
So a couple things I would say. So let's add steel, let's add lumber, let's add automotive parts, and I think we've got up to about 10% of the TSX market capitalization. Remember, broadly speaking, the TSX is a financials, precious metals, and energy index. Variety of other things. We've got some great leaders in waste management, rail, a variety of industrials that I think are great retailers like Couche-Tard. But the issue I see when it comes to the TSX, there are a number of businesses that are quite stable. You think of the utilities. You think of the telecoms, which have done extremely poorly for an extended period of time because of concerns on price competition and a regulatory environment that seems to be changing about as much as it seems to change in the United States. So those stocks are relatively low-risk ways of getting 4, 5, 6% dividend yield without taking a lot of risk. And I'm not sitting here saying that these stocks can't go down. I mean, if we really do some real damage to the S&P 500, they will be down. But I think that's there. I think the insurers, the life insurers particularly look good. You can get, again, 4 or 5% yield on a bunch of them, trading at 12 times earnings, and most of them are globally diversified. You know, they've got operations both sides. We have utilities with 50-50 business mix between Canada and the United States. So I think there are ways to do this and invest in equities without experiencing a lot of pain. I would say, though, I do think carrying above levels of cash makes sense, and you can own U.S. money market yielding, if not 4, close to 4 currently, in a risk-free environment. And again, if the Canadian dollar weakens because of a lot of the economic ramifications, I think you're in good shape on that as well. So I think above average cash positions skew pretty heavily towards dividend-paying stocks, and particularly dividend-paying stocks with relatively defensive business models where you know what the earnings are going to be in 25 and 26.
Okay, so let's circle back to what you first said, which is what you think this is all about, discounting in the USA, so that's where people invest their money and spend their money. Given that, do you see that objective being, being met anytime soon? Or are we in for this great up and down until Trump, the administration, sort of run out of steam with the tactic?
I would say you haven't seen anything yet.
Oof.
April the 1st and April the 2nd are extremely important dates. They will be the apex of the trade dispute at that point in time. On the 1st of April, there are in excess of 20 reports to be tabled by Homeland Security, Department of Justice, U.S. Trade Rep on everything from digital sales taxes, automotive, existing trade deals, currency manipulation, and they are all going to be tabled on the president's desk on the 1st of April. Now, he didn't like that because that is April Fool's Day, so he said he will decide on those. So I presume he's going to stay up all night reading all 24 of those reports, cover to cover, and then on the 2nd, he's going to institute what I think is pretty predictable here, which is tariffs on a whole variety of products as we move forward. We do need to get to that date, Marilla, I think, before we get real visibility from here. So the whiplash you're talking about, to me, the confusion if you're paying attention, it's still evolving. I think we have another a period of time until we get to that point. And then we can sort of see where we go from here. From our point of view, there's no reason to rush on equities until we get past that point, unless we really do much more damage to the equity market.
And just so I'm clear, you think there's going to be a much more targeted set of tariffs instead of, hey, all of steel and all of energy and all of this. It'll be a more targeted series of...
I don't believe that. I believe it will be more scattershot. It will be broader. It will be reciprocal tariffs across a variety of things. So the thing we've seen is, for us, it feels incredibly erratic because as Canadians, we feel it because it is impacting our business quite directly. The reality is, on the second, it's every country in the world that takes this heat. So then the debates vary by country.
Yeah.
You know, Japan and the EU, it's automotive imports coming. It's not just USMCA goods moving back and forth. It's actual imports coming in. There's agricultural issues in various parts of the world. India's tariffs run at 15% compared to Canada and the U.S. running at 1.5% on average goods. The reciprocal tariffs, these things are what they're going after. So I would say to you, there is another, we think of Canada and Mexico and USMCA. To an extent, there is a de facto renegotiation of USMCA going on.
Already going on.
Already. Okay. Like, you know, I'll do here.
Not officially, but
not officially, but
yes.
Unofficially it's moving forward. And I can see the difficulty that our politicians have in deciding how to respond to that, whether it's premiers or
the
Prime Minister Trudeau on his way out. So there's all those types of things that are making it difficult. I think once we get to that April 1st, April 2nd, then the target moves from being quite narrow to being much broader. So I do think, I think it's actually going to be a lot more idiosyncratic, a lot more disruptive, I would say, as we move forward.
And just when I was wishing I had not asked that question, I didn't want to know. I did not want to know that. Now I have to prepare. Ian, thanks for coming in. Appreciate your time.
Thank you.
Coming up after the break, Tesla stock dropped this year under competition from rival electric vehicles and other things. We'll talk about that when we come back.
This life, practicing medicine on the high seas, not being stuck. It's addictive, exhilarating.
Dr. Odyssey, all new, Thursday, 9/10 out on CTV.
I seen the bitter with the sweet, victory and defeat. Sometimes I fell, but a voice kept saying, son, stick to your vision. Keep the composition. Seen a lot of shame in the game.
Donate at lovescarborough.ca.
For the fourth consecutive year, Interactive Brokers is one of the fastest growing prime brokers and is now number 5 in Preqin's ranking of top prime brokers. Interactive Brokers serves both organizations and individual investors. To get better results, get a better platform. The best informed investors choose Interactive Brokers.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
one of the worst single-day sell-offs in the history of the company, that is Tesla. Trump threw his support behind the billionaire Elon Musk, vowing to buy one of his vehicles. Let's talk about the turmoil at Tesla with Jay Van Sciver. He's a partner and industrial sector head at Hedge Eye Risk Management. Thanks for joining us today.
Great. Thank you so much for having me.
Let's talk about what we're seeing happen with Tesla. It's lost, what, 45% of its value in, well, since the start of the year. What are you reading as far as to the why? How much of this is about his role in Washington?
Well, I think it's a multi-factor situation. One of the things that did happen was the decoupling after the election for Tesla from fundamentals. And that was, as we called it, the alpha emergency, where you saw this big rally coming out of the election because Musk, was more visible, and that was perceived as providing an advantage. And what we've seen more recently is a recoupling of Tesla shares with the fundamentals, which are objectively poor.
What do you mean? Explain that.
So, for example, used Tesla prices are down quite a bit. We see registrations across geographies, whether it's in Europe or the U.S., weakening in early 2025. So the first quarter results are going to see a good deal of pressure. And just over a slightly longer period of time, say over the last year and a half, we've seen earnings estimates for Tesla come down fairly dramatically, 50, 60%. And that is something that should put more pressure on shares than we had seen over that period. And this is really a catch-up with what is going on at the company.
But do you not factor in the sentiment of people who have decided or taken an anti-Musk stance?
I think that is a key factor that is driving some buyers away from Tesla, but the competitive offerings for Tesla are much more robust than they were 2-3 years ago, even a year ago. There's excess capacity at a lot of rival manufacturers, and you've seen companies like Lucid or GM cut prices on their EVs, making the whole competitive set more challenging for Tesla. It also is obviously unhelpful to have Elon Musk become a divisive political figure associated so closely with the brand. We run a regular survey of Tesla's brand that we've done since 2018, and it does show a rough halving of respondents' interest in the Tesla brand relative to other brands. So definitely a factor, but it's in this context where there's just much better offerings than there were previously in the competitive set.
Where do you see people taking advantage of what else is out there, choosing something beyond Tesla, as you say, because there are better products now? Is that happening more in Europe? Is that happening more in the U.S.? Where are you seeing it?
Most notably, you hear about it in China, where BYD has some really nice-looking vehicles that are highly competitive and often cheaper than U.S. or European alternatives. In the U.S., you've seen the South Korean brands, Kia, Hyundai, taking share, although you also see some compelling offerings from other OEMs in the U.S., like BMW sells more models of EVs than Tesla does. And to some extent, Tesla also just has a dud with the Cybertruck, right? It's a little too distinctive, not selling particularly well. We've seen used Cybertruck prices already at a discount and discounting on the vehicle itself. So it is, not a refreshed lineup. They're trying to introduce a new Model Y, the Juniper. That has created some, I think, production and supply challenges across the platform. But for the most part, Tesla's competitive set is what it's been, and that's given rivals a chance to take some share. And of course, in Europe, it's a much more competitive market and has been for some time.
When you are looking sort of down the road, no pun intended, for Tesla, I'm just wondering what you see. If you're seeing this drop now and you're saying much of that might have to do with the better competition out there, do you expect Tesla to lose more value moving forward?
I do. I do think that this is an industry that will get increasingly competitive, that Tesla, in retrospect, will be viewed as a pandemic bubble stock that benefited from supply chain difficulties and product introduction difficulties at its rivals, and therefore earned excess returns in, say, 21 and 22. That will be, obviously have come down quite a bit. That will continue, and that this will look more like a traditional auto industry. People want to paint Tesla as an AI or robotics company, but when you actually look at the R&D spending and CapEx, they simply don't spend anything like really an auto company, let alone a real technology or robotics leader. And I think they're structurally stuck in a low margin business that just doesn't allow the reinvestment for them to be the technology leader that a lot of shareholders would like them to be.
Does it hurt that you now have a leader who's, I guess, focused on something else right now and maybe not paying attention to the company?
So 5 years ago, a lot of people thought that Elon Musk was going to manufacture cars to save the planet. And a lot of people today seem to think Elon Musk is going to save government in some way through this mechanism. I think it's just a replay of the same movie. One of the difficulties of covering Tesla is that I've looked at Elon Musk and his behavior for a very long period of time. And what's changed is that people are recognizing kind of how he is. And I do think that is something that is brand negative, but he isn't necessarily the entire thing, right? They do have cars, they do have employees other than him, and we'll see how his divisive political activities reflect on the brand over the long term. Volkswagen was started by Hitler or whatever, and it worked out eventually. So. I think it's difficult to say that in the long run it will impair the brand. In the short run, it certainly is a negative.
Jay Van Sciver, I've got to leave the conversation there, sir, but thanks for your time today.
Thank you.
Coming up next, airlines under pressure with weakening demand and, of course, that uncertainty about the economy. More in a moment.
Hi, I'm Jim Gordon. You're watching Market 1 Minute. Joining us is Kit Mars, Western Alaska Minerals. Talk about the company's unique investment opportunity.
Well, what really makes us special and unique is really three things. One, we have the potential for very large scale. Second is very important. We have one of the highest grade silver deposits in North America. And the third is jurisdiction, which is becoming very important today. We're on 100% state of Alaska land.
Tell us more about your assets.
We have, again, a very unique position. We have a large carbonate replacement deposit system. What sets us apart is we actually have two resources, one at either end, the high-grade silver at Water Pump Creek, 75 million ounces of silver equivalent, and also 500,000 ounces of gold at the past-producing Illinois Creek mine.
Kit, thanks for joining us.
Thank you.
This Charmin Ultra Soft Smooth Tear has wavy edges.
It's no ordinary square. Charmin Ultra Soft Smooth Tear has wavy perforations that tear so much better, with more cushiony softness. Enjoy the go with Charmin.
If you're looking to invest, Capital Direct's One Income Trust could be right for you.
Our track record boasts stable income, portfolio diversification, and compound growth.
Throughout 2024, Capital Direct's return trended upwards.
Find us online.
Call today.
CapitalDirect.ca.
On a $100,000 US margin loan, Interactive Brokers charges just 5.83%. Do you know how much your broker charges? Fidelity and Schwab charge over 1.5 times as much. E-Trade is even higher. Move your account to Interactive Brokers and save at least $5,200. Or much more if you're trading big bucks.
The Ontario Premier Doug Ford has agreed to suspend a 25% electricity surcharge for power exports to the U.S. and says he will discuss a renewed CUSMA deal ahead of the April 2nd deadline. Although reversing course on a 50% hike, U.S. President Donald Trump now says that 25% tariffs on Canadian steel and aluminum imports will begin at midnight tonight. A meeting between Ford and the U.S. Secretary of Commerce Howard Lutnick, that's scheduled for Thursday. The war in Ukraine could soon see a 30-day truce. A statement on the Ukrainian president's website says the country's ready to accept a proposal if simultaneously observed by Russia. Now, in return, the U.S. says it will lift its pause on military and intelligence aid for Ukraine. During recent talks in Saudi Arabia, the U.S. and Ukraine also discussed prisoner swaps with Russia, as well as a possible deal for natural resources. And Trump's administration is soon going to require some Canadian travelers to register in the U.S. if they plan on staying there more than 30 days. The draft rule, which is set to take effect April 11th, would require those travelers to submit fingerprints and create an account with the U.S. government. The rule would exclude those under the age of 14, but those over 18 are being told they must carry proof of registration at all times. Delta Airlines has reduced its outlook, citing weaker demand for travel and all the economic uncertainty. Let's go to Stephen Trent on that. He's head of America's Airlines and Latin Transports with Citi. Thanks very much for joining us today.
Well, thanks for having me on.
So Delta and American now both saying the same thing. They're seeing a weaker demand for travel, and they're revising their outlooks as a result. Do you expect others to do the same?
Yes, absolutely. I think there is a risk we could see a similar pattern that goes well beyond those two. You have uncertainty on a governmental level in terms of investors and consumers trying to make heads or tails on tariffs. What these Dodge cuts are going to mean, not only in terms of demand for government travel, but also in terms of staffing at the FAA and other agencies. And while we've had all of this uncertainty from a top-down level, since the beginning of February, you've seen several serious aviation accidents. Unfortunately, all but one of them were fatal. I think all of that has an impact on short-term demand.
When you are looking at what typically happens this time of year for these airlines, how busy they are, I'm wondering if you've started to see that slow down early, maybe in February as a result of the crashes, or are we looking sort of down the line and thinking that that trend will continue, or something sort of completely new for the summer where they're not getting the bookings ahead of time that they would normally get?
Yeah, absolutely. So it would be disingenuous of me to say there's no risk to summer bookings at all. I think the group itself is watching that very carefully, and one thing in terms of action that they could take is to make important capacity adjustments. So we had a mini version of this scenario last July, for example, where in the domestic market, there was too much capacity over the short term, and the group responded to that and cut significantly. So 3Q, we did see that unit revenue inflection point. But I remember, look, the January and 1Q overall is a somewhat tough time for the group, primarily because of weather patterns. And this January, for example, maybe some of these natural phenomena were a little bit worse with the wildfires out in California, for instance.
Talk to me about the crashes. Is there an immediate either reversal in bookings, sort of sentiment that you can see in the airlines or in other sort of travel-related industries as a result of those crashes happening?
Yeah, so certainly on a short-term basis, one thing that would be of concern would be what happens to demand, and is there any book away on the back of these events, or people just deciding not to fly at all. So certainly, unfortunately for the airlines that are directly impacted, there is some operational dislocation associated with these events, unfortunately, where some capacity absolutely gets disrupted. But I think in terms of the broader reaction, a little bit hard to say. I think there are a lot of factors that can influence what happens after that. For example, what was the reason that people think was the main cause of the crash? Was it the airline's fault, or was it not the airline's fault? So I think those can be two opposite ends of the spectrum.
Yeah, and as you mentioned, some of that could be seasonal, right? Was there ice on the runway? Was something like that made that so much worse? Let's look forward again, because I'm wondering if some of that sentiment, concerns about crashes and weather, fades as we get into spring and summer. I'm then wondering, are there deeper problems in the industry that they'll have to deal with, considering the possibility of recession in North America, both the U.S. and Canada, the trade war that makes people sort of wonder what's going on and if they're going to be laid off. What do you foresee there until the end of the year?
Yeah, look, I think airlines, as with other businesses, and probably more intensely than other businesses, airlines don't like uncertainty. And certainly as we look between now and the end of the year, how do these top-down factors play out? Are we in a contrived economic slowdown at the start of one today? It's probably above my pay grade to make that comment. But certainly I think what we look at, summer bookings, absolutely. And is there a risk that we see sort of broader issues with the group? I think all of those are risks. What I would highlight, and what I think is the good news so far, is the weakness that's been called out has been largely contained to the domestic U.S. market, domestic leisure, with including, for example, the operational dislocation around those specific aviation accidents. So the international corridors still look very good. Loyalty program still looks really good. So by and large, the network airline verticals are on all cylinders, except U.S. domestic.
Okay, so just from your point where you are connecting with people in the leisure industry, is there a further knock-off effect yet on tourism in the U.S.?
Yeah, look, so I think the empirical evidence so far is there has been some impact on U.S. tourism. Some of that may be coming from political rhetoric and bilateral disputes. Some of that probably naturally comes from U.S. dollar strength, that foreigners visiting Disney World today, it's not as cheap as it was 5 years ago. So yes, that's something to watch as well. And maybe at least on the margin, we're seeing some impact from that.
Got it. Stephen Trent is head of America's Airlines and Latin Transports with Citi Research. Thanks very much for joining us today.
Thanks for having me on.
And we will be back in a moment. Stay tuned.
Growing your wealth can be a steep hill to climb. That's where the Murray Wealth Group can help. The high-performing Global Equity Growth Fund has a 15.9% 5-year return, managed by the Murray Wealth Portfolio team, now available to advisors.
It's great to be connected on a plane, but not all the time.
Get more from Canadian banks and insurers with HEB and HFN. Exposure to Canadian banks and insurers with 0% management fees until January 2026. HEB and HFN on the TSX. From Hamilton ETFs.
When you get together with friends and family, remember to ride. Reduce impaired driving everywhere. Because ride starts with you. It starts with a designated driver, and in the kitchen when you offer guests non-alcoholic drinks, when you call a friend to come and pick you up, and at the corner when you catch the last bus, in the driveway with a simple "keys please," or in the living room when you decide to stay overnight. However you ride, thanks for doing your part to keep our roads safe. A message from Arrive Alive, Drive Sober.
You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals.
Get Fisher Investments Comfortable Retirement Kit and help make your retirement a success. 1-888-601-1186.
Have someone on your side to keep you on track. If your retirement portfolio is $500,000 or more, call us today.
Get your free Comfortable Retirement Kit. 1-888-601-1186.
It has been an escalating day of tariff tension, but after some back and forth, the White House confirming now a 25% tariff on Canadian steel and aluminum will take effect as planned at midnight tonight. Canada exports 10 million tons of steel to the U.S. So how is this all going to work, and how is it going to impact this industry? Let's go to Catherine Cobden, President and CEO of Canadian Steel Producers Association. Catherine, it's hard to even keep up, right, with what is going on. But you heard the latest announcement from the White House, 25% tariff in effect as of midnight, better than the 50 threatened. But what's your reaction?
Well, thank you, first of all, for having me it has been a very wild day with lots of twists and turns. What I will say is we didn't see the paperwork yet on the 50%. We assume that therefore the executive order that shows the 25% is what we're facing tonight. It's certainly been a day of great uncertainty, which I think is very difficult for the industry. Even 25% is a significant challenge for our industry. And so I don't want everyone to think, well, it's now just 25%, there's no problem. It is, in fact, very impactful. We have had already, with the threat of the situation, we have had job losses, production curtailments, and investment deferrals. So this is a serious situation for the steel industry. And we're happy to see a step forward, but we need to keep going.
Who's going to bear the brunt of the cost hikes? Is it going to be the producers? Is it going to be the sellers? Is it going to be the buyers on the other end? How do you see this working?
It's a bit of a combination of all of the above. Some customers may be willing to absorb the tariff. Many other customers will not be. But that's why I always talk about impacts on both sides of the border. It's not just the Canadian domestic steel industry that pays the price of these tariffs. It's also the U.S. consumers and such. In 2018, when we had these tariffs, we did see prices soar. We know that they will have an inflationary effect. Over time, we're really hopeful that we'll be able to get into a discussion of how strong we are working together versus attacking one another tit for tat in terms of tariff and trade war.
How many industries in the U.S. will be affected by this change in the cost of Canadian steel or a slowdown in pushing it across the border?
The most incredible thing about steel that I've learned since coming to this industry is we're everywhere. We are in all sorts of strategic industries, so automotive sector, defense sector, energy sector, renewable energy sector, infrastructure, the list goes on and on. Manufacturing, heavy equipment, it's an industry that has a wide reach in terms of supply chain. And you mentioned it in your intro, but we have a very significant steel trade back and forth between the United States. We have about a $20 billion trade between our nations. So it's a lot of steel. And it will have impacts as the prices rise and as the supply chains are disrupted. And as I said, obviously in terms of job losses and the like here in the industry. One of the things that this current situation is driving us towards is, especially at 50%, that's like a complete loss of the U.S. market. 25% will be tough too. So we're asking Canadians and our Canadian governments to think hard about what we can do differently for Canadian steel use in our own country. We have a lot of unfair trade here in this market, and that's what the U.S. is fighting against in their market. We have the same fight to give here. So that's one of the ways we hope to get out of this in the long term, because the uncertainty is not helping anyone.
To your knowledge, can the U.S. even supply the amount of steel it needs if Canada pulls back?
No, I mean, we do supply about 23% of their import market. We're their largest importer of steel. And so at a 50% tariff, and we can't, there's no way that's happening in terms of a commercial ability to do that commercially. So, they're going to be steel short. 25% may still see some of that. So where are they going to get their steel from in the short term? I understand and appreciate there may be lots of intent to build new steel plants, and I've heard President Trump talk about reshoring of manufacturing. But in the immediate term, there is still quite a bit of steel that's going from Canada to the United States. And so, we hope it's ever thus, frankly, but, certainly we have a very strong trading relationship. We hope to maintain it, but these are the questions we have to ask ourselves.
You mentioned that perhaps the federal government needs to come into this and figure out ways to have more Canadian steel sold in this country. What are the barriers to that right now, and what could the Canadian government do?
Yeah, so we see, and this is done judicially, so you can see this on the Canadian International Trade Tribunal's website, an awful lot of unfair trade that is happening in Canada. So we are having, we're trying to compete with countries and companies from offshore that are coming in and really dumping into our market. And we can't, that's not a fair trade environment. So we're happy to compete with fair traders, but unfair traders, we are not. So our government has tools at their disposal that we are encouraging them urgently to put in place. And this would include things like tariffs at the border on unfairly traded countries. We know who they are. We should add more tariffs at the border to prevent the unfair trade we're facing. And frankly, just to give us a level playing field where we can compete. We've always had this request, but now that we're losing, but we always had the U.S. market. But now that U.S. market is getting significantly more constrained and frankly, maybe even completely lost, we need to do things differently in our own market. That's one example. I have a second one, actually, if you'll give me one more minute, and that is buying Canadian for infrastructure projects and major projects of development in this country. If we're going to, fund a major infrastructure project, we should be ensuring that we're prioritizing our domestic industry, our domestic jobs, and our domestic communities first and foremost. And if we can't supply it, that's another matter. But frankly, we should be more strategic in how we source steel supply for these projects, especially when they're funded with taxpayer money.
Catherine Cobden, I have to leave it there. I'm out of time with you, but really appreciate you coming on with what's going on, or your perspective on what's going on between the U.S. and Canada. Thank you very much.
Thank you very much. Thanks.
So coming up next, we'll take a look at some top picks in fast food stocks. Stay tuned.
That's so nice to have you home.
I like the sound of that.
A new season of Sullivan's Crossing starts Sunday, April 27th on CTV.
The rubber hits the road on a new season of F1 on TSN.
I have missed this. This is so close. Brilliant. This is Formula One at its absolute finest.
And it all fires up down under.
Welcome along to the Australian Grand Prix.
On TSN and TSN+.
Focus on your goals. Trust in our ETF experience. BMO has been offering ETFs to Canadians since 2009. BMO ETFs. Build on trust. Learn more at bmogam.com/ETF.
Introducing the Brompton Cash Flow Kings ETFs. Investing in high cash flow yielding companies, putting their power to work for your portfolio. Brompton Cash Flow Kings ETFs. Because cash is king.
Whoa, how'd you get your teeth so white?
You gotta use the right toothpaste.
Dr. C?
Not all toothpaste whiten the same.
Crest 3D White removes 100% more stains for a noticeably whiter smile.
New personal best.
Crest.
The Harvest Diversified Monthly Income ETF. Consistent monthly income. The Harvest Diversified Monthly Income ETF. HDIF on the TSX.
Head & Shoulders Bare. Clinically proven dandruff control with just 9 essential ingredients. No sulfates, no silicones, no dyes. Dandruff control. Minimal ingredients. Job done.
We serve Canada's wealthiest investors. Center Wealth Partners of CG Wealth Management deals with investors who have $10 million or more of liquid investments. Contact us today in complete confidence. We'll be here when you're ready.
Bitcoin is surging as major financial institutions rapidly integrate it into their portfolios.
Bitcoin since the election has gone from $60,000 to $100,000.
Deregulation across the nation means strong support for Bitcoin, and Hive is thriving. Hive is positioned to quadruple their global footprint in 2025, aiming to capture 3% of the world's Bitcoin supply. Hive Digital Technologies.
Time now for Hot Picks, taking a look at some fast food stocks. Earlier, we sat down with Andrew Charles, Managing Director, Restaurant Analyst, TD Cowen. He shared his picks, starting with Cava Group.
On Cava, this is the name under our coverage, and for folks in Canada who may not know the concept as well, they fast casual Mediterranean. So think of this as a Chipotle that serves Mediterranean food. So vibrant concept, vibrant category, as well as the fact that there's a company that we feel very confident will be able to beat and raise when it comes to EBITDA as well as same-store sales this year. We've seen a tough start for the restaurant industry in 2025. We think this one's immune from it with an improving unit economic story longer term and a long runway for growth in the U.S. that makes us very bullish on Cava.
So when you say it looks like it's with a Middle Eastern slant here.
That's right. Yeah. So it's the Mediterranean category. So mostly on Greek food, but, expands the Mediterranean. And so, you see interesting things like spicy lamb meatballs, tzatziki sauce, crazy feta that really differentiate this one versus the peers. And it's a cuisine that, frankly, is hard to trade down to in the United States, as well as hard to replicate at home, that we think gives the business a moat.
Yeah, spicy lamb meatballs, and they got spicy lamb with avocado. I'm getting hungry here. Dutch Brothers, what are they all about, please?
Yeah, so Dutch Bros is the third largest coffee shop in the United States. And so what it is a standalone drive-through. There are picnic tables, but there's no lobby, there's no interior. So the ROIC quite high. Brand is very portable too. They're starting on the West Coast of the United States and expanding eastward, where they're seeing improved ROIC, improved unit economics as they expand. That's really fueling the growth. And so we like this story as a positive sales revision story to help gain multiple expansion, really as they implement some of the key drivers within the coffee shop industry. And what I mean by that is they just launched mobile ordering across their fleet in the third quarter of last year. That's still a small part of their sales. It's only about 8% of the business today. You compare that to Starbucks at 31%, long runway for growth, what we believe to be a very incremental occasion. If we fast forward, beyond 2025, that we think will be dominated by the mobile order story, food is going to be a key driver in 2026. And so right now they're testing an assortment of different offerings to include. They believe they're missing a market or a consumer here that wants something to eat with their coffee purchase. So big opportunity as well to continue to make this a positive sales revision story, not just for 25, but also for 26. And if I can go one step further, we're bullish on coffee as a category. We talked about Mediterranean category for Cava a moment ago, but the coffee category, what we're seeing in the United States is an aging consumer. And our survey work suggests that consumers drink more coffee as they age, particularly when they go from the 18 to 24 cohort to the 25 to 39 age cohort. Entering the workforce, entering parenthood leads consumers to drink more coffee. And Dutch Bros is the concept under our coverage that our proprietary survey work skews perhaps the most, to that 18 to 24 consumer. So we're pretty bullish that as their purchasing power picks up, as their caffeine consumption picks up, this is going to fuel a great long-term story for Dutch Bros.
And I think you said they don't offer seating, and I've seen a few Starbucks outlets that are the same without seats. And Starbucks is a stock that you think is a decent bet right now as well.
Yeah, so this coffee theme also helps Starbucks as well. And so you're right, that Starbucks, about a third of their recent development has been this drive-through only prototype. They totally get the maximized return on invested capital this has. They recognize that, even in their existing stores that have a drive-through, it's a very powerful channel to have. So you're absolutely right, Andrew. They are starting to focus more on drive-through only concepts throughout the United States. And within Starbucks, as you mentioned, our number 3 pick, not only are we bullish on this coffee tailwind the concept should be able to benefit from, but the new CEO they brought over from Chipotle is a Hall of Famer. We're really excited about the opportunities he has to really implement the Chipotle playbook at Starbucks. So think of it as better operations, better speed of service, as well as better marketing as well for a brand that historically didn't focus much on advertising. We think there's a lot of low-hanging fruit that'll help support him in his turnaround journey.
Yeah, it is interesting that, I mean, coffee, just before we let you go, it is fundamentally a very high margin product, isn't it?
Absolutely. And I think one step that's also really important here, younger generations show higher proclivity to get coffee outside the home. They also like iced coffee too. And we believe that not only just the iced coffee, which is harder to replicate at home, you know, when you think about most of the at-home offerings, they're geared for hot consumption, and iced is really the clear growth trend. Combined with all the digital innovation you've seen with loyalty programs and mobile order, we think there's going to lead a lot of stickiness here for the coffee shop channel.
That was Andrew Charles, Managing Director, Restaurant Analyst, TD Cowen. All right, if we look now at how the loonie moved today to see all of the news that was bouncing around, it was up in the green earlier, then it did a drop around noon. Remember, there are threatened tariffs of 50% on steel and aluminum by the U.S. That has been drawn down later in the day. Let's see how the markets reacted as well. The TSX down today, again, 132 points or 0.5%. S&P also down by 42 points, and the NASDAQ down 32 points today as well. And this Friday, we're bringing back Talking Tax. This week's topic, filing taxes as a freelancer or when self-employed. So you can tune in every Friday, 4:30 to 5 p.m. on The Close to ask your tax questions. You could also send your questions in through an email, bnnbloomberg.ca, tax@bnnbloomberg.ca. And that does it for today's program. Thanks for joining us. We'll see you tomorrow.
The Close is brought to you by Emirates. Fly Emirates to Dubai and beyond to over 140 destinations from Toronto and Montreal. Fly Emirates, fly better.
In today's turbulent markets, Starcore works to minimize risk and maximize shareholder value. Our established management team is unlocking the mystery of the source of mineralization at our producing San Martin gold mine, while using free cash flow to explore our portfolio of advanced assets in Mexico, Canada, and Côte d'Ivoire, Africa. With no debt, Starcore offers investors leverage at every stage of the mining lifecycle, from exploration to production. Learn more at starcore.com.
What keeps baby's skin healthy? A diaper that doesn't leave skin wet. That's why Pampers Swaddlers absorbs wetness better for up to 100% leak-proof protection and 0% skin irritation. Pampers, for healthy baby skin.
Is this how you're hoping to retire? Well, hope isn't a good retirement strategy. You've worked for a comfortable retirement for years. Now you need to plan for retirement income. Learn ways to avoid common mistakes, like being too conservative or not setting retirement goals. Have someone on your side to keep you on track.
Call for Fisher's Comfortable Retirement Kit with the help you need to make your retirement a success, including the Investor's Guide to a Comfortable Retirement, 12 retirement investment blunders to avoid, and 7 secrets of high net worth investors. Call 1-888-601-1168.
Fisher Investments tailors a plan to keep you on track for the retirement you want. And as a fiduciary, we do better when our clients do better.
Call now for your free Comfortable Retirement Kit. 1-888-601-1168.
If your retirement portfolio is $500,000 or more, call us today. You don't have it coming to you unless you plan for it.
1-888-601-1168.
Introducing the Harvest Diversified High Income Shares ETF. One ETF holding a basket of individual Harvest High Income Shares ETFs with high monthly income. Harvest Diversified High Income Shares ETF, HHIS on the TSX.
On Bloomberg, context changes everything.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside Joe Matthew, I'm Kaylee Lyons.
Stocks pull off their lows today as President Trump reevaluates plans to double steel and aluminum tariffs on Canada in light of Ontario backing off its surcharge on electricity sent to the U.S. We'll discuss the economic fallout from all this with economist Tiffany Wilding at PIMCO.
Ukraine accepts a U.S. proposal for a 30-day truce with Russia as part of a deal with the Trump administration to lift a freeze on military aid and intelligence. We'll have the latest from our national security team as we wait on a response from Moscow.
And we'll talk with Republican Congressman Marlin Stutzman of Indiana as the House prepares to vote as soon as this hour on a stopgap funding bill to avoid a government shutdown on Friday. Thanks for being with us on the late edition of Balance of Power. On this Tuesday, President Trump reconsidering his plans here, as we've been reporting, to double steel and aluminum tariffs on Canada. This after Ontario announced it would suspend a 25% surcharge on electricity sent to the U.S. So the president was asked about the tariffs earlier this afternoon. Here's what he said.
He was a gentleman. Look, I said it before. We give Canada $200 billion a year. We subsidize Canada between all of the things we give them and trade. We give them, we don't have to have cars made in Canada. We don't have to have lumber from Canada. We have tremendous lumber. We have tremendous trees. All I have to do is unfreeze them from some of the restrictions. And frankly, the way that gets solved is Canada should honestly become our 51st state.
And joining us now with the latest is Bloomberg's Sean Donnan. So, Sean, the White House has now confirmed via a spokesperson that the 50% duties on Canada, specifically for steel and aluminum, will not go into effect. They just, as of midnight tonight, get a 25% levy like everyone else.
Yeah, like the whole world. I mean, it's steel and aluminum tariffs, but I think one of the big themes that's kind of gone unsaid or kind of under the radar a little bit here is that a lot of consumer goods are going to get hit by these tariffs as well. Something like $150 billion in consumer goods are going to get hit as well. So this is not just about steel and aluminum. It's about anything that has steel and aluminum in it. And that's very different from what we saw the first time around. That means the economic impact of this is going to be much broader than what we saw the first time around.
You had a great story on the terminal and on the website today, everything from baseball bats to caskets. When we consider where steel and aluminum goes here, is it possible to quantify the impact on all these products?
Look, it's as I said, it's something like $150 billion in products, and it's not just baseball bats. It's fishing reels, it's fishing nets, it's camping stoves. It's pretty much anything you can think of that has a piece of aluminum in it. And this time around, they're not just targeting the aluminum, they're targeting the entire product. So that fishing reel that you're going to buy your dad or your mom for their birthday is going to cost 25% more after midnight tonight.
Well, and putting aside the Canada spat over the electricity surcharge and the threat to take these up to 50, it doesn't seem that this is a negotiating tactic in the same way, Sean, that we've seen the other tariffs threatened on Canada and Mexico, where there are specific things related to fentanyl and the border the administration wants. Is there anything a steel and aluminum producer, it seems right now, can do to get out of these tariffs?
Well, so steel and aluminum producers overseas are going to be lobbying through their governments to get exemptions, as we saw the first time around. But, you know, the steel industry here in the United States has been holding pretty firm on urging the president to not allow any exemptions. And that means we're going to see this broader impact. I think, you know, the real thing, the theme that kind of has emerged over the last 7 weeks as President Trump has rolled out these tariffs is there's been a lot of volatility inside a day, as we saw again today. But you see a step up in tariffs, and those tariffs have a broader effect. And that's what we're seeing in the markets. The market's starting to get concerned about those effects, those economic effects, the slowing economy, higher inflation, and that's what we're going to be seeing in the months to come.
Yeah, Wall Street has been quite a ride recently. Sean, thank you so much. Sean Donnan has been spearheading our coverage of the impact of the tariffs. You can find a lot more, as I mentioned, on the terminal and online. And for more analysis, we turn to Tiffany Wilding, economist at PIMCO, to try to get our heads around the impact here. Tiffany, it's great to have you. Welcome back to Bloomberg TV and radio. When you consider that $150 billion worth of goods that Sean was just telling us about, can you then quantify the greater economic impact that would have here in the U.S.?
Well, I think the point that I would just emphasize on steel and aluminum is that the steel and aluminum industry is a fraction of the size of the industries that are, what he calls sort of downstream, that use steel and aluminum. So you have the auto industry. Anybody that wants to build plant or equipment in the United States probably needs steel to do that. So you have to be really careful, I think, when you're implementing these tariffs on business inputs or inputs to other things, because they actually make investment in the United States more expensive. So it's just something that you have to think about in terms of quantifying here. Ultimately, there will be some costs that are passed on eventually to consumers. And I would say the overall costs of this, as a result of those higher costs, are larger, than the steel and aluminum industry, which they're trying to shelter.
Well, and then that's not even layering on all of the tariffs that have been promised come April 2nd, Tiffany. This is really only just the beginning, and already you're starting to see in some of the sentiment data the fear of tariffs looming for consumers. How long does it take, though, for them to actually show up, knowing we're getting CPI data tomorrow that is likely not going to reflect this, for that harder cost data to actually materialize in the figures we see?
Well, actually, I would just caution against that a little bit, because as we've moved, especially in retail, when you think about these tariffs going up on retail goods predominantly, so we have a 10% effective tariff rate increase on Chinese imported goods that actually did go into, it went into effect in February. We can see that actually quite quickly being passed on. And I say that because in an increasingly digital world, what economists used to call menu costs. Like, you don't change prices frequently because there's a cost. You have to print a new menu to do that. If you're Amazon or anyone else that's selling online, there is zero cost to change prices. So as a result of this increased digitization, we see prices that are reflecting economic conditions much more quickly. So I would actually say it's quite possible that we start to see people even potentially front-running with more gradual price increases, so they don't have to make large adjustments. So we could start to see it in February, and then continue to see it, in the months to come. I would just say on that, we do see it in the soft surveys. We like to, we have these diffusion indices, purchasing manager indices, and what we've seen is that prices received have started to tick higher, even before some of this, the tariff stuff has actually been implemented. So I think we're going to see it.
Yeah. Well, Tiffany, economic theory has been getting a little abstract around here in the Capitol recently. Listen to the way House Speaker Mike Johnson put this earlier today, talking about the concerns the market clearly showing over this tariff strategy. Here he is.
I think of it sort of like when you're playing billiards and you're playing pool, right? You go on the table and the balls are racked, right? And you hit it as hard as you can. This is many people's strategy in the game. You hit it as hard as you can to break up the balls on the table and send them spread. Then you play the strategy of sinking them in the holes, right? That's what we're doing right now. It is a shake-up. Sometimes when you shake up, that it's a violent thing on the table, right? In the game metaphor. But it always works out well in the end, and I think you've got to give them time.
Tiffany, I don't know if they included billiards or pool in your Econ 101 class, but how does that ring to you? Because you've got lawmakers and others in Washington who are making decisions based on these ideas.
Yeah, I mean, so I think that, there has to be an understanding that regardless of what is actually implemented, just the volatility around the announcements of all of this has created uncertainty. And as you suggested, it started to reduce, the more elevated economic sentiment that we saw post-election. And I would just say it's relatively costless for somebody that owns a business to hold off on hiring and investment until this uncertainty lifts. And so, I think you have to be really careful, because in the interim, you can see some real economic weakness, and what economists really get worried about is when you have financial markets that are reacting to that higher uncertainty and some economic weakness, and you get accelerating effects. And you don't want to see those accelerating effects really contributing, to a bigger downturn. So at some point, right, you want to, basically try to pull back, at least on some of that volatility and uncertainty, so you can get an economy that, is still humming along and not heading into a recession.
Just quickly, Tiffany, the Fed has been very clear that they are waiting for greater clarity on a lot of these policies before they change their mind on anything. But seeing what we're seeing with a tightening of financial conditions, at least when you're looking at the equity market changes you've already discussed, potentially consumer behavior could start showing up in the data. How quickly could the Fed change its own mind?
Yeah, I mean, ultimately these sets of policies, it's just a tricky environment for the Fed, as many people have said, right? Because you do have a one-time price level adjustment that will be associated with these tariffs as businesses pass them through. And unless they're